Could be real estate, could be a theater ticket, or a conference or a concert ticket. It could be a commodity. Does that mean that a tokenized representation of all of these real-world assets are covered by MiCA or not? And there is no simple answer to that. Some are not. For example, a single house that is tokenized, assuming this is possible at all under the law in which the country is, where the house is located. But let's say this is possible under national law. The token representing that house would not really fall under MiCA, because it's just one token, one title to a house, and MiCA doesn't really address that. These tokens are also not necessarily issued, nor are they traded on trading venues for crypto assets. However, imagine you have the same house, and rather than having one token, you're going to fractionalize it, and you're going to say, well, I now have 1 million tokens, and each token is a 1 millionth of that house. Those tokens can be issued and distributed, and those are more likely to be covered by MiCA, or are coverable by MiCA if the issuer so wishes. Then the question is, well, if they are covered by MiCA, or if they can be covered by MiCA, are they asset reference tokens? Because of course the reference asset is a part ownership in the house, or are they what we call general crypto assets of a utility nature, where they are a claim or give a right to a service or a product, and a house in a way, well, is a product. Both interpretations are, in my personal view, valid, so both are possible, and it really depends on what the token creator, the token issuer, envisages. If he or she envisages to fall under Title II of MiCA, so a general crypto assets as a utility token, they have to do a white paper describing all the rights associated with the token, and they have to notify that white paper to an EU authority, and then they're good to go. Of course, the EU authority, a national competent authority in a member state, may take issue with that white paper, may say, well, look, we don't really think this is a general crypto asset, we really think it's something else, and then they can raise objections to that, in which case the white paper will not be sort of endorsed or validate, or it's objected to, so you do not get a passport on that. Or they may say, well, look, this is really an asset reference token, and you should refile this as an asset reference token, which has a much more detailed requirement. It's Title III of MiCA, which requires prior authorization. So you as an issuer need to be authorized. Your white paper needs to be approved. You need to hold reserve assets. These reserve assets would logically be the house that is represented by the token. But, and then comes complexities, there are requirements on liquidity of reserve assets. And this is still being worked on, but a house is not the most liquid of instruments. Of course, you can always sell the house and sort of turn it into something liquid, but this takes time. And if you are an asset reference token, there is automatically a redemption obligation. So the holder of the token can always redeem his or her token against the reference asset or the current market value of the reference asset. So the issuer, let's say that the issuer has a house, made 1 million tokens on it, which are asset reference tokens. I happen to have 100,000 of those tokens, which I want to liquidate, and rather than me selling them in the market to someone else who's willing to give me the money for it, I said, no, I'm not going to sell them in the market. I'm going to go back to the issuer, and I said, look, I want to have 1/10 of the house, the issuer is obliged to give me 1/10 of the house, which is impossible because he can't cut it up. Well, I don't think it's advisable. So he will have to give me 1/10 of the value because I can always redeem in cash. So that's a bit the framework. So long story short, MiCA provides a framework for tokenizing real world assets, but it's not always that straightforward. And if you want to do it under MiCA, this raises a number of questions. Before I leave this introduction, is while MiCA does not cover financial instruments, but covers instruments which are non-traditional financial instruments, so not derivatives, not equities, not debt instruments, and so on, no funds. And while the Commission presented it when it posed this in a non-sector specific way, so we did not intend to make a piece of financial services regulation. The fact that it emerges from the Financial Services Department of the European Commission, and that it was negotiated in the European Parliament and the Council by teams that are focused on financial services, makes that the legislation, MiCA, has a lot of ideas and elements which originate from or are inspired on financial regulation. And therefore, a lot of people think that MiCA only is suitable for instruments or tokens or tokenized real world assets that are financialized, if you wish, that are traded as transferable assets. And if you tokenize a real world asset, but the purpose of it is not to make it transferable, that's just a feature, but it's not the main purpose, then MiCA may not necessarily be the best framework for you to operate under. There may be instances where you can't escape MiCA, but if you have the opportunity to decide whether you want to come under the framework or not, if the purpose of the real world asset, the tokenization of the real world asset, is not to financialize it, to sort of make it as a store of value, or turn it into a payment instrument, or to use it for transactional purposes, then the MiCA logic isn't necessarily best suited for you. That, of course, leaves a question, well, if you're not, as a tokenized real world asset, are not covered by MiCA, what are you covered by, if anything, under EU law? And here the answer is, well, it really depends. There's certainly no specific framework for you to fall under, but that doesn't mean that nothing will apply to you. For example, if you were to tokenize intellectual property rights, which are also a real world asset in a way, I guess, while this is, you can financialize intellectual property rights, in which case they could come under MiCA, but let's say that you're not financializing them, they're staying outside of MiCA. That does not mean that intellectual property regulation no longer applies to them. So tokenized intellectual property rights are still covered by intellectual property law. Tokenized assets sold to tokenized real world assets sold to consumers are covered by general consumer protection regulations, be it product regulation, service regulation, market conduct regulation, distance selling regulation, and so on. And so if you either by design or by choice fall outside of MiCA, you may still have to contend with all of these other regulations. Whereas if by design or intent or fact you fall under MiCA, that becomes your primary regulation. And the other regulations, while they not necessarily do not apply, they may in some instances also apply, MiCA would be the core regulation that whenever there would be a friction or a conflict between these rules, MiCA would take precedence. I'd like to leave it at this in terms of outline, sort of say, well, how would real-world assets fit into the EU regulatory framework? Sure, they fit in, but it's sometimes a bit of a square peg in a round hole. And leave it to questions and debate. Thank you.
Thank you, Peter, so much for coming and staying with us. And I hope, I would like to invite you to stay for the panel and see if you have some of your opinions shared here. Of course, I know you're busy, so up to you. And now I want to start the actual panel. Tokenization, as discussed here, is one of the most fundamentally important movements moving forward for the industry. And now that we have a bit more clarity, I think a lot of people are very excited about what's going to come. Which is why this panel is called Tokenization Unlocked, Practical Insights into Compliance and Real-World Applications. In the panel today with me, there are a number of distinguished speakers, all of them having a very concrete interest in tokenization. And I mentioned them earlier, but I want to give them the ability to introduce themselves. And I'm going to start from the lady of the group. So Diana, the floor is yours. Please give us a few words about yourself.
Thank you, Xenophon. Can you hear me well?
Mm-hmm.
So nice to meet you all. I'm Diana. I'm currently head of compliance at Compilot. Compilot is a software development company which serves projects in Web3 and Web2. Before I joined Compilot, I was working in crypto industry since 2019 when I joined a small crypto exchange called Crypto.com, very small at the time. I've seen the growth of this company from less than 1 million clients to 80 million clients. Initially, I joined Crypto.com to help them track suspicious transactions. So I was head of transaction monitoring. Later on, as we start scaling up, I was promoted to head of regulatory compliance, applying for licenses across the world. And then when we stabilized the growth, I became director of global compliance program, overseeing all compliance program across several continents. I also built compliance program at another centralized exchange called BitGet. And I also work for a financial regulator, Financial Conduct Authority, FCA UK in London, where I was senior policy advisor for consumer credit markets. That's about me. Thank you.
Thank you very much, Diana. Next one I see here is Alessandro. Alessandro, the floor is yours.
Hi, thank you for this opportunity to talk with so many people about compliance and tokenization. I'm Alessandro Brigato. I'm project manager at Blockchain Italia, partner of INATBA, and I'm leading different projects. We develop products in DeFi industry like Volksfinance. We develop products in notarization field like Dedit.io. Recently, we were awarded at INATBA Awards, and leading different national and international projects related to traceability. For example, for the Made in Italy in the Italian space with the Italian Trade Agency, and also for another project is COFAM for carbon credits standards. And I also lead a product that is called Tokenox. We are going to launch it, and it's related specifically to tokenization of document and improving digital flows and workflows, so related to document management through the tokenization. Thank you.
Thank you very much, Alessandro. And I see Frank next. So Frank, the floor is yours.
Yeah, thank you all. Yeah, my personal background is restructuring, bankruptcy, everything that can go wrong in businesses. That helped me vital for more than 20 years, and that led me to blockchain. And the pure essence of blockchain, which is distributed ledger technology. So an immutable ledger to have means that we can mitigate operational risks, like the bankers name those, counterparty risk, document risks. Alessandro just mentioned that problem with documents. People don't believe often that so many things can go wrong when companies get financed on the basis of the value of their business assets. And that's pretty much it, what we realized at Myron with our, as we name it, the proof of asset application. It's pretty much it. It says you need to have legal certainty and enforceability over everything that you finance in businesses. We took out receivables financing and inventory financing. By the way, as I used to say, the markets are huge. It's something around 10 to 12 trillion dollars. If you include the most complicated part of it with this, which is international trade finance. But we have pretty humbly started with receivables financing of companies that we take the data of those companies that have rendered services, that have supplied goods to their customers, to their end customers, which creates legally the receivables. And all these data that we take from the ERP system of a company and store it by a magic algorithm on the blockchain in a way that any time later down the road, a potential administrator, a potential third-party creditor cannot contest the validity, and the underlying data of those receivables, or in case of inventory in a warehouse, that these assets were situated in that warehouse when the ownership was transferred. Ownership transfer is the next thing to mention.
Thank you. Before we start, I want to give the introduction to Romedi as well, because he didn't get a chance to be introduced.
Sure.
We have an agenda, so we'll start from the first question afterwards. Romedi, the floor is yours.
Okay, I'll keep it short. Hi, everyone. My name is Romedi. I'm a legal partner at MME. MME is a Swiss legal tax and compliance firm. We have a very strong focus on fintech. We established Ethereum Foundation in 2013-14. And after that, actually, all the big projects came to us, and that allowed us to grow our fintech team substantially. So now we have about 25 people that only work on fintech projects. And then, of course, about 100 people more that work on related things like immigration law, tax law, and everything. I mean, we always draw on these experts if a project from abroad comes to us. And in terms of real-world assets, we've had the first tokenization project 2016-17 was tokenization of ownership in gold. And we saw that after 2017, when there was a big crash, investors, they wanted to have something, a real-world asset behind the token and not just a token. So after that, it really took off, and we had a lot of projects where we tokenized gold, diamonds, wine, revenues from cattle farms, you name it. And yeah, we advise in all legal, tax, and compliance aspects. So usually we start with the regulatory assessment of the project, and then we implement everything that they need. So set up a company, take care of immigration, draft all the agreements, and so forth. Thank you.
Thank you very much, Romedi. Thank you all from the panelists for being here with us. And I want to start with the first question, which I think everyone here understands, but it's also a bit more specific than what people might have in mind. So what are real-world asset tokenization processes, and why do they matter? How big is this potential market? The floor is open to everyone. Whoever wants to start, go ahead.
Yeah, I can maybe start from the legal perspective. So maybe just to give you a bit of an understanding what it actually means. So tokenization of real-world asset means that you link the token in a way to a real-world asset, so that if you transfer the token, if you hold the token, the ownership of the claim that is linked to this token is also transferred. And it's very important because it makes transferring ownership or rights much easier. You have this decentralized ledger. I think, Frank, you mentioned it before, that you have a ledger that is tamper-proof, where also the issuer cannot make any changes. Then, of course, once the real-world assets are tokenized, they can be used in Web3. So you can, for example, give it as a collateral and get a loan very easily. We have set up an exchange and settlement platform where it also proved to be very a nice solution, that you actually have trading and settlement at the same time. You can do it instant settlement as opposed to the current exchanges that usually have settlement T+1 or T+2. You can also have the real-world assets. Once they're tokenized, they can be smart. So, for example, they have a maturity date. After the maturity date, they're automatically deleted. And you can also use the DLT or the ledger on which these assets are issued for additional purposes. So what we have done is, for example, use the ledger also as a share register. So you had the shares tokenized, and at the same time, when the transfer took place, the share register was updated at the same time. So it brings a lot of benefits.
Thank you. Alessandro and Diana, I saw both of you on mute.
Okay, so related to real world asset, we can say that the tokenization of real world asset, it's the process of converting physical and tangible assets, like we said, real estate, commodities, art, even company shares or bonds, into digital tokens. So these tokens represent the ownership or a right. And so we have maybe we just gave an overview to our auditors, to our audience, but maybe you don't own the fraction of real estate actually, but you know the right to claim the yield on this asset. And so most of in the most of the cases, the assets that are tokenized still exist in the physical world. So you have a digital twin, but the token acts as a digital counterpart that can be divided into fractions and sometimes traded. How does it work? Depend on the blockchain, on the technology. In general, we set a smart contract for the supply, for the token generation, for the tradability. In other ecosystem, we don't need smart contracts. For example, in Algorand, we have native assets. And why they are important? Because maybe we already said at the beginning, but we try to create liquid asset in the market that generally are illiquid. So you think a fraction of a watch, or fraction of a building, or fraction of small companies that are not listed on the market. And in addition to this, we gave efficiency and transparency thanks to the blockchain use. And how big is the market? It's very huge, because we talk about, generally I show two slides when I talk about tokenization. One, it's the document management and digital electronic signature. We can tokenize even the files to improve digital flows. And one is related to real world asset. There are two scenarios, but we talk about in the best one, 10 trillions, because we have I think 1 billion now in tokenized bonds, at least 1 billion. And we have every kind of asset could be tokenized, starting from the soy, the humus, till to we said the real estates, building, bonds, and so on.
By the way, that is what strikes me, Alessandro, to connect to that. Market-wise, I mean, it's intriguing that you have now 2 trillion or so market cap in crypto, and if you take out of that what is really connected to real-world assets, including securities, which is, by the way, the liabilities and equity part of a balance sheet, if you see it this way, then it's, I mean, 2 billion maybe a little bit more. I don't know. It's a fraction of it. And then you see the financial markets, any paper that is out there, any sort of financing, we are in the hundreds of trillions. Just as I said before, I mean, if you only take working capital financing, then we are talking about $14 trillion currently volume worldwide.
Yes, because I think that is now we have obstacle for the Web3 adoption, for the crypto adoption. But when we talk about real world asset tokenization, we give another perspective. We give access to financial or not financial, but we are talking about the market. So generally, we talk about new financial instruments that can lower the barriers and find more attraction even in the retails and small investors. And So I think that's the reason why we cannot compare the market about the adoption in crypto and adoption that could be in real world asset.
Thank you very much,
Just
Diana.
a few words from me, if that's okay. Yeah, sure. I try to use a very simple definition because it's already quite a complex technical concept where lots of people don't understand what RWA tokenization is. So for me, it's process, like Alessandro said, it's a process of transforming tangible assets into digital tokens on the blockchain. And this technology, I think, holds the potential for reshaping the financial landscape in the future, definitely, and it already started doing so. I remember when I started in crypto industry, crypto assets use cases were mostly confined to the digital realm, an asset that is available only on the blockchain, somewhere very abstract, compared to traditional financial assets that actually exist in the physical world. We now, I think, entering into this era of crypto evolution where we have real world asset tokenization, which will bridge the gap definitely between the physical and digital world. And the potential for growth of this market is massive. It's predicted to reach around 16 trillion by 2030. So definitely there are lots of huge opportunities in this market, but obviously there are also technical, compliance and regulatory challenges that we'll hopefully cover in this topic today.
Thank you, Diana. And actually that leads very well to the next question I have for the panel. We have a potential 10 to $16 trillion asset class that can be tokenized. We are at 2 billion. Pretty big disparity, especially considering that the crypto asset market is 2 trillion primarily from assets that had no background and have no concrete value indicators, yet they've reached to $2 trillion pretty rapidly. So what are the challenges and barriers? And why do companies face these barriers when trying to tokenize real world assets? How do we challenge? How do these challenges impact these projects, and how much of it is based on tech limitations versus legal uncertainties? Are there any strategies that can be used to address them effectively? And I want to give the floor to Frank first for this, but perhaps others would like to add some feedback on this.
Yeah, thank you. I mean, first of all, I believe it's mindset, right? I mean, you have here this crypto industry with a 2 trillion market cap, and you can make a lot of money there. And people have made a lot of money in trading into whatsoever. And that has led to a distraction because, I mean, the TradFi industry is pretty much scared about that. If it comes to crypto, any asset manager says, well, that's the super high risk product. And that's a pity because blockchain allows to do it very secured and very certain legally. And that is, I guess, to overcome. If it goes down to the barriers, I mean, people so much talk about regulatory issues, and we have heard the introduction with regard to MiCA. MiCA is a thick paperwork, but only covers the regulatory part, and only these 2-3 maybe one very tiny little and one more sizable country and a federal state in the US have dared to create a legal framework. And you need the legal framework like in Liechtenstein, like in Switzerland, and if I understand that rightly, in Wyoming in the US, that clarifies that a token can not only digitally, but also legally represent an asset, a tangible or intangible asset, but a real world one. And I mean, the politicians have to work on that, maybe on an EU level, to drive more jurisdictions to do so as well. And only then you get the others, I mean, that you need. I mean, the businesses on the one hand and potential asset managers on the other hand, to see the beauty of blockchain if it comes to real legal certain ownership transfer. Romedy has mentioned it, and I guess you have alluded to Swiss law, which allows this legal representation in an enforceable way. Same, I mean, we found it in Liechtenstein because they also offer ownership transfer or ownership representation regarding physical assets. That's the major difference between those two countries. But it's only those two. Maybe plus Wyoming.
Yeah, maybe I can jump in because you already mentioned me. In Switzerland, there was a bit of uncertainty with regard to tokenization of claims up until the DLT Act was put into force in 2021. So before 2021, we always tokenized ownership. That was already possible under Swiss law. But then as of 2021, it's also possible to tokenize stuff in the form of a claim. So you don't own or co-own a specific gold bar, but you only have a claim to receive, for example, 1 gram of gold. But yeah, one thing that really holds this whole real-world asset tokenization a bit back is that there are certain uncertainties with regard to, well, how or what does it actually mean to tokenize? Do you have a claim? Do you have ownership? Is it a security? Is it a public deposit? In Switzerland, we have quite clear guidances on under which regulations they fall. And we are quite happy actually that MiCA is being put into force now at the end of 2024, because we had it sometimes that issuers were in Switzerland and then they ask, well, can we target investors from Austria, from Germany, and so forth. So we had to do several analyses for each of the different countries they wanted to actively target, and MiCA will make it much easier. So a legal risk or a challenge will be mitigated in the future. The biggest challenge that we see or saw, in particular in the past, I hope that will be solved in the future, is these projects were, especially at the beginning, very successful in selling the real-world asset tokens. Over time, people realized, well, there is no regulated market to sell the crypto asset again. So there was less interest on the primary market because there was no regulated secondary market. Right. Also there are exchanges that are working on it. We have currently, I think, 2 pending applications here in Switzerland for a so-called DLT trading system. Berner Börse, BX Digital will get one quite soon. And I think if we have a regulated secondary market with liquid markets, that will change a lot, not only for the secondary market, but also for the primary market.
Thank you. I see a lot of people unmuting themselves, but I see Peter unmuting themselves. So Peter, would you like to add anything to this discussion?
Yes. So ultimately, this is a matter for the EU national law, because national law governs what is ownership and how is this done. There are a number of reasons why people may want to tokenize a real-world asset or want to demonstrate that they own something. Sometimes it's important, sometimes not important. Let's say I go to the market and I buy a kilo of apples. These apples are now my apples. I can't prove it that they are. I don't have an invoice. I just bought on the market, but they are my apples. The fact that I possess them is probably a strong indication that they are my apples. But there's no interest for me in tokenizing these apples because the apples are there to be eaten, or eventually they'll just sort of rot. And so certain assets do not lend themselves, or there's no advantage to tokenizing them. Others, there's an advantage to tokenize them either because you want to demonstrate ownership and a history of ownership, like, for example, take provenance of art. This is a very complicated issue, and there's documents about it, but one can imagine that if this ends up being tokenized, that the token would be a very good demonstrator proof of provenance. Other assets which are ideal for tokenization are assets which are difficult to hold physically or difficult to transact physically. Of course, some people love looking at gold bullion and keeping it in their vaults, but transacting gold bullion is a bit clunky, it's a hassle. And so it may be better to have a token representing either a certain amount of gold or a specific gold bar. You can do both, and both systems are being tried. So certain assets lend themselves better to tokenization than others, either because they are better for the safekeeping and the management of the underlying asset, or because you want to demonstrate proof of ownership. But not everything that can be tokenized will be tokenized, because sometimes it just doesn't make any sense. Now, of course, we still need to see quite a lot of progression in national legal frameworks as to what proves or what demonstrates proof of ownership. Traditionally, this was all kind of paperwork and contracts, and in real estate, you need a notarial act, and some countries are moving ahead and sort of said that this notarial act can now be digitalized, but in some, no, it has to be on paper. And I compare this often to the debate which we had 10, 15 years ago about electronic signatures. So before, the only signature that mattered was a handwritten signature. And while we could not necessarily regulate this at EU level or harmonize this, we have actually found a clever way. We said that member states must give electronic signatures the same legal value as a handwritten signature. So we did not harmonize what is the value of a handwritten signature. That it depends on national law. But we say you must recognize electronic signatures that meet certain standards of being of no less value than a handwritten signature. And so I can imagine, while we cannot harmonize what precisely an ownership title means, because that's a matter of national law, I could imagine, I'm not saying that we are thinking about it or that we're going to do this, but I could imagine a framework where we say that a tokenized ownership claim should be given the same legal value as an analog ownership claim, a contract or a notarial act or whatever. We're not thinking about this right now because if we were to do this, we would face enormous opposition because this is a matter of justice ministries, and they are, I hope you know justice ministries, right? They are notoriously slow in coming around to new ways of thinking and innovations. But I'm an optimist. Even though they're slow, they'll get around to it eventually.
Right.
Thank you. I have a very quick follow-up question for you, Peter. Do all tokenized assets within crypto assets fall under ARTs, under existing regulation?
No.
Okay, thank you very much.
So just that, because the thing is that they are more likely to be utility tokens than they are ARTs, because for ARTs you need to sort of have, they need to be fungible and so on. So the short answer is no.
Thank you. Diana, I know you want to add some insights on this. The floor is yours.
Sure. Whilst we are on legal and the compliance challenges of tokenization, just wanted to add my perspective as well. As an ex-regulator, I know lots of local regulators, they actually struggle when the new technology like tokenization comes into place. They do have to play catch-up game because, first of all, they are under-resourced very often to regulate huge markets like tokenization in this case. Secondly, even if they are well-resourced, they're struggling with the technical expertise. They don't have experts who understand blockchain or crypto very often. And even if they're well-resourced and if they have technical experts, they really struggle how to balance their objective of consumer protection, market stability, market integrity, and at the same time, not to stifle innovation in these markets, right? So they have to find what regulations best fit. Do they create completely new regulations for this new technology, or do they shoehorn the existing regulations into this new technology and then potentially kill the innovation? So I think these are the challenges that regulators at local level definitely struggle with, and I've seen it across a number of EU countries. And also, just to mention, a lot of clients come to us at Compilot, and because we do serve tokenization platforms, we provide them our compliance end-to-end management. And they ask us, do KYC and AML regulations apply to tokenization projects? So this is another big question, like, do they? So I advise them, yes, they do. They might not directly right now, but they will do in the future, definitely. And also, even if you don't want to do this tick box exercise, where you say, okay, I'm compliant with AML KYC regulations, you want to ensure that the people you're dealing with in your tokenization projects are not criminals, right? So you must do your KYC, you must check who your investors are, you must do screening on them to ensure they're not politically exposed people, they are not sanctioned individuals, and so on. So yeah, definitely, we had this case where when I worked at Crypto.com, when I just started, we were not obliged to do KYC. Crypto exchanges were not regulated at the time. So we chose to comply in advance. which made our life much easier when the regulations actually hit. So this is what I advise my tokenization projects who are coming to me for advice. I said, look, the regulations will come sooner or later, so you better be well prepared and start preparing your systems right now before you scale up. Because I think when you grow from a 1 million customer to 80 million customers, it's much more difficult to introduce all those compliance management systems retroactively, to your 80 million customer database when you have to do it to 1 million customer database. So this is just for me, just 2 cents. Xenophon, back to you.
Thank you very much. Do we want to add anything else here on transition barriers, or shall we continue to use cases and how they can be incorporated within startups and companies? Okay.
Yes, just to want to add one thing, because you cover most of the topics on this question. So the first one, of course, is the legal framework, the national jurisdictions. And so in many cases, you talk about Swiss jurisdiction. We saw the tokenization process in Switzerland, and maybe the development could be in Italy, I think, to Arcton for company shares, I think to Collecto for luxury watches and art pieces. So we have many use cases about that. But one of the topic could be, the other ones is the technology. We have to set and harmonize also the technology, because when we talk about token, NFT, often I give an overview with different kind of standards on blockchain. So we have fungible, not fungible. Everyone knows ERC20, ERC721, but there are so many standards. So technology and builders continue to solve needs thanks to the blockchain, but we need to harmonize them, because there is not just Ethereum virtual machine compatible, but there are many permissionless DLT. And the other one, maybe Peter talk about digital signature, is harmonizing also digital identity, because in a tokenization process we need to have transparency, so we need to harmonize. And in Europe we are going to release to adopt the EIDAS 2.0 and maybe the EUD wallet in the next year in 2026. But it's necessary, because when I talk about tokenization in document management, for example, we need to understand who take part to the process. When you talk about third parties, creditor or other stakeholder that take part to the process, we need to have KYB, we need to have KYC, and have an harmonized ecosystem, at least in the European members. So I think there are three pillars that we have to merge, and we need to talk about all these pillars in the meanwhile, while the technology continues to build.
Thank you. Just a quick follow-up on this. We can't have tokenized assets en masse without identity on chain, correct?
We cannot have
tokenization of assets en masse on chain without on-chain identity, from what you just stated, right?
But depends what do you mean, and what for on-chain identity, because for tokenize an asset you need smart contracts, you need the wallet. It could be custodial or not custodial, and maybe in the next platform, for example, in the platform we are going to launch, we have the creation of wallet for every user. Sometimes even in notarization, so before the tokenization, we integrate digital identity processes. In Italy, we have speed, national ID, and another. You have 3 different ways to be compliant with the authentication. And in blockchain, we have many other kinds of digital authentication. So we talk about different topics on this on authentication, and at least if we are going to harmonize the existing ones. When I talk about speed, is national digital identity provider in Italy. There is ID national card. In Spain, we have 2 different ways. In Norway, we have 2 more. And we are talking about Web 2 processes. We are not talking about Web3 new processes. So we have to harmonize them, because I can relate my log with a speed, for example, or with the wallet in the future, or I can authenticate myself with a KYC with different stuff. So it could be a topic in the future.
Thank you. I see other people that try to unmute, but we do have a couple other questions. Does anybody want to talk anything else on this? Okay. I'm going to move, and I think we'll touch upon some of these topics again in a second. There's a couple of other questions. The most important one for me is, how can companies effectively incorporate tokenization in digital workflows? I mean, what are the best practices for them to have a successful implementation? And I want to start with Frank on this, because I know Frank also had a couple of use cases to share about how tokenization works. So Frank, the floor is yours.
Thank you. Yeah, it's indeed. I mean, it's again all about business financing and working capital financing, so yield generating assets of businesses. And I mean, the gap is obviously there. I mean, you have either completely unbankable businesses, so the micro SMEs or smaller SMEs, and you have certain regions in the world where financing is difficult to get on your trade. And by the way, I take the example of Peter with the apples. I mean, usually you don't think that an apple or a bunch of apples need to be tokenized, but if you're the farmer and you have a stock always available, then you have to kind of pre-finance it, because you can't sell it at the same time as you pick it and you harvest it, and you need your PP&E for harvesting everything. So financing is always needed, and that is, I guess, the most attractive part of using this distributed ledger technology to make that more efficient and more secure. And more secure means only it's more accessible for both parts, for both sides. You can take intermediaries out of the equation, and then it's in the end cheaper. If you take international trade finance, everything is factored in what can go wrong, what is still analog paperwork, what goes wrong in bankruptcies in supply chains of certain merchants. And that leads to a situation where a merchant in a complex supply chain internationally has to pay up to 30% per annum in costs, fees, and interest for getting his trades financed. And that is, I guess, the most conceivable part of using that technology. By the way, as I said, trade finance is the most complex one. We have failed attempts like Marco Polo, as you might know, this big R3 subsidiary that tried already with Hyperledger to embrace that market. So we have to be humble with that. But back to the stock of apples, or the stock of everything that you want to trade on, there is a need of financing. And that needs, by the way, to finalize, to come to your question, digital workflow. And that comes first, right? You need to have some sort of digitization of this business. If it's all paper, I mean, you can tokenize, and you can't use any data to store it on blockchain.
Go ahead, Peter.
No, I think it's a very important point that Frank mentions. And trade finance is highly complex, it's highly analog, and huge costs go in it. And a lot of businesses fail to engage in international business or selling their products abroad, because not that they don't have a product they can't sell, but they can't organize the financing around it. The trade finance dimension basically stops them from either exporting or importing goods. And blockchains offer an enormous opportunity to facilitate and to streamline this value chain. When it comes to the apples, indeed, farmers need to hedge their risks, and they need to finance their apple orchard, so they can indeed present tokens which are offer tokens which are entitled to the apples. But then these really are apple futures, and these are financial instruments, because the apple future comes with a risk. Because okay, yes, I'm an apple orchard, and I'm going to grow 10 tons of apples. but I need money to pay my employees and everything. So I sell these futures. Fine, everything go. I get the money. I can organize my business. And then there's a huge storm, hailstorm, and my apples never materialize.
That's the Greensill example, right?
Yeah.
I mean, they also sold future receivables, which have not been created legally at the time when they were sold.
And so the question is that can you tokenize real world assets if the real world asset does not yet exist?
That's an interesting question. I mean, that's an interesting. I mean, as I always say, I mean, even there is. I mean, because it's all about. I mean, what is risk? And what is so expensive, even in asset-based finance for financial institutions? It's proof of asset and maybe even proof of production. And the good news, on the other hand, is that all the technologies are already there and they are pretty easily available, and they are very, very technologically advanced. So a warehouse can be tracked by easy security cameras that are already there, for example. And if you take the apple production, the harvesting, I mean, people don't know that like those ones like myself that were in bankruptcy business are of everything that can go wrong, and not only serious fraud, right? I mean, like at Greensill, that was serious fraud. But also error can lead to a lot of risk accumulating, and the technologies are there to give proof. I mean, to track production processes, the content of a warehouse. Is it still really there? And I mean, blockchain is only one means to facilitate then to give the most secure, the most certain access in the case, and that's always the point, in the case of a failure. I mean, it's all about a potential failure of a merchant to pay back what he has received in financial means. And I mean, that's a huge cost, bankruptcy risks, foreclosure risks, and so forth that are still factored in financing costs.
Thank you. I know Alessandro also wanted to add some points on this. If not, I can continue to the next question afterwards. Alessandro, the floor is yours.
Yes, I think I agree with Frank. So I'm very focused about that every kind of process could be tokenized, because we can have a previous value. No, when we talk about tokenization, we think about commodities, gold. We think about and we write about illiquid market. So the first case, often it's the real estate, fractionizing and so on. But I think that tokenization can help companies, product like ours, but other solution on the market for every kind of digital flow. So the first step is start to digitize everything, tokenizing asset, because you have much value for every kind of entities or body that took part to the process. So then we can add value. So don't start from thinking about digital asset, because we have gold, we have, I don't know, soy farmers, as I said before, a humus producer, and we want to collateralize it, and we think about DeFi logics, because that it's okay, it's surely a solution. But starting from the beginning, we can tokenize every kind of process, and we have certainty of the supply, certainty of the documents. And just to give an example, because the time is running out, we can have an onboarding process on HR. So you can tokenize the letter of interest, then the contract, and then you can have different paths between the employee, the employer, and maybe a certifier, or everyone could take part of this process. And then if you want to add value, a contract could have a value, because you have a salary, you have part of the salary for maybe for taking loans. For example, in Italy, you can have a loan on 1/5 of the salary. So there are different scenarios. But if you have tokenized, you have smoother processes. You have low problems. You can to balance the cost of tokenization. But if you use, if you standardize, if you give a standard to the tokenization, if you have modular workflow and user-friendly platform, you can add value to every company in every field, in my opinion.
Thank you, Alessandro. So on to my last question. We have 5 minutes left. Unfortunately, some of the questions in the chat won't be addressed simply because we are running out of time, but they're quite interesting. So we've talked about apples and hummus being tokenized. How does tokenization actually improve operational efficiency and transparency within organizations? Please provide any key success stories and lessons learned if possible, and any key factors that led to this success. So I know a lot of people here might want to add comments on this. Who would like to go first?
I can go. So I think the project where I saw the biggest increase in efficiency was one where we tokenized financial instruments. If you're familiar with how financial instruments are traded in the traditional world, is you go to your bank, you say, I want to buy that share. The bank has an account at the stock exchange. They put in the trade. The trade is matched. Then a CCP has to take over the liabilities and take over the risks. Then you need a CSD that actually has the shares in custody and does the settlement, and then everything has to go back again to the client so that he sees it in his own bank account statement. And that was extremely inefficient because each one of these intermediaries, they had to do checks and balances and to do reconciliation. And what we did with tokenizing the financial instruments, and especially having this DLT trading system in place in the middle, is that the retail client can automatically, without having his bank involved, be a participant in this DLT trading system, and there he can enter trades, and these trades are also settled immediately. So you have actually only the end user and the DLT trading system, and everything is taken care of. So that was, from my perspective, the most, the biggest increase in efficiency. But I agree. I mean, it doesn't make sense to tokenize everything. Apples, we've heard an example where it makes sense, but actually, if you have your apple in your hand, always when possession and ownership is at the same place, tokenization doesn't make sense. But as soon as these two diverge, because the ownership is somewhere, the gold is stored somewhere in a bonded warehouse in Switzerland, it can really make sense to tokenize it.
Thank you, Romedy. Frank?
That brings it to the point, by the way. I mean, that's exactly it. And that is what happens in finances. And currently, you need trust. So the one that has the ownership or believes to have the ownership has to trust into the document, firstly, that it has been transferred, and secondly, that there is the Bailey holding really the possession for him. And that lack of trust leads to many financing costs. But that's for me.
Thank you very much. Now, there's a couple of other elements in this question, right? Specifically, legal and compliance side, about transparency specifically. Has this increased transparency, and can we touch upon this quickly? Okay, we can definitely talk a lot more about this. Trade finance through on-chain applications, a topic discussed earlier, is also just a massive discussion that I think INATBA should lead in the future. I want to thank Peter, who was the first one to leave, Romedy, Diana, Alessandro, and Frank, as well as everybody else here who came and joined us and is listening to our discussions. This was the first discussion point of the second day, but there is more coming in roughly an hour. So please take a break to get your apple and hummuses and get excited about tokenization, and then join us afterwards for the regulatory impact on blockchain and financial services, specifically shaping the future of money, assets, custody, and the evolving financial ecosystem, which is going to be moderated by the Finance Working Group. Culture is at Begum Rajan. and it's going to feature a number of topics and discussion points. So please join us in 1 hour. Thank you all for joining us this far. Thank you again to the speakers, and join INATBA and the Finance Working Group if you want to have a voice in these discussions moving forward. Thank you.
Thank you. Thanks, guys.
Thank you, Beck.
Thank you, everyone. Bye-bye.
Thank you. Bye. Bye.
Hello?
Hello, Paolo. How are you?
Hi, very well, thank you.
I think Cynthia is about to put us in a breakout room for the speakers so that we have a few minutes. Hello, Wailum. How are you?
Hi, good. Can you hear me?
Yes, we can hear you very well.
Great. Thank you so much. Nice to meet you.
Nice to meet you too. And thank you for joining us today.
Thanks for having me.
Of course. So I think you have a pop-up on your screen for those who are speakers, and we
Yes.
in the
It has disappeared.
yes, it has disappeared. Cynthia,
Yep.
can you send it, please?
And so we joined that, okay?
Yes. Mm-hmm.
Not appearing.
Nope.
Hi.
Hi, everyone, and welcome. My name is Xenophon. I am part of the INATBA executive team, and I'm very happy to start the second part of today's Day of Finance with a number of topics and distinguished guests. This is part of INATBA Blockchain Digital Week, and in this week, we ensure to cover the most important topics with the best people available. Today, we are going to be talking about the global regulatory roundup and how all of this impacts the industry. I'm going to start by, first of all, welcoming everyone and giving the floor to Izzat Begum Rajan, who is the co-chair of the Financial Working Group and the leader of this discussion. Izzat Begum, the floor is yours, and I look forward to hearing what you have to say.
Thank you very much, Xenophon, and welcome everyone today to this session. The title is a bit long, but I think it's self-explanatory. It's about the regulatory impact on blockchain in financial services and how we see the future of money, assets, and custody in an evolving financial ecosystem. My name is Izzat Begum Rajan. I'm a board member at INATBA. I'm also the co-chair of the Finance Working Group with my very good colleague, JC Metonet, who cannot be here today. I'm also the co-chair of the Industrial Blockchain Task Force, and we published a report on 14th of July that is available on our website. I also happen to be the founding partner of Imani Partners, my strategic advisory firm set up in Paris, but operating globally and helping emerging technologies to be better adopted and have implications and positive impact in the industry in particular. Today, I will be moderating a session with my good colleagues on the call, and we have Paolo Briniardello, Miguel Vaz, Ronald Cogens, and Wailum Kwok. We're going to start with a discussion around the regulatory landscape, both in ADGM and Switzerland, thanks to Ronald and Wailum, and they will introduce themselves shortly. After that, we're going to have a panel discussion on our main theme. And at the end of the session, I'm going to have a fireside chat with the excellent Lana Schwarzman from Notabene, who will dial in a little bit later. So without further ado, perhaps Wailum, you can introduce yourself, and Ronald as well, and then Wailum take the floor again so you can tell us more about the regulatory landscape in ADGM. Thank you.
Thank you, Izzat. Hi, everyone. Good afternoon. I'm very happy to be here to be able to share my perspective as a regulator who would have been regulating in this space for the past 6 years to, at a high level, what kind of things we are seeing and how our trends has evolved. So a bit of introduction. I head up the authorization, which is the licensing function of the financial services regulator in the Abu Dhabi global market. For those who are hearing about ADGM for the first time, we are the International Financial.
Wailum, sorry, your sound is not coming through.
And to be able to support the economic diversification strategy of Abu Dhabi. Thank you.
Wailum, my apologies for interrupting. Your sound broke up for about 15 seconds. Could you perhaps say your last sentence again?
Yep. So the Abu Dhabi Global Markets mandate is to support the economic diversification strategy of Abu Dhabi. And we are focused on the financial services sector. And for me as a regulator, my role is to regulate the financial services firms that are established in ADGM. Thank you.
Thank you, Wailum. Ronald, would you like to introduce yourself?
Yeah. Hi, everyone. My name is Ronald Cogens. I'm a partner at the law firm MME here in Switzerland. My main focus is financial market law, fintech, technology, and corporate law. I'm working in the Web3 fintech space since 2016. The firm itself is already in the space since 2012 because MME helped to found Ethereum here in Switzerland. And our firm is advising clients for all kinds of projects in that space. So we have a lot of developers that are launching a new layer 1. We have layer 2s. We have DAO structures, but we have also regulated players that are looking for staking solutions for their clients. We also have the creators of financial products with crypto as underlying, ETFs or ETPs with crypto as underlying. or other kind of financial structures. And we also advise clients in setting up security tokens exchanges here in Switzerland.
Thank you very much, Ronald. So perhaps my first question will be to you, Wailo. Can you tell us more about the regulatory landscape in ADGM and how does that financial center deal with the challenges of tokenization of both money and assets?
Right. What I'll do is I'll take your question along with a high-level overview of the work that we are doing. And hopefully along the way, I'll be able to address some of those questions and also perhaps questions from the floor. So what I'll do now is I'll proceed to share my screen. Let me know once you are able to see it.
Yes, we are.
Right, great. So as the title suggests, I think I'm happy to be able to share with all of you some of the perspective in the Middle East as a financial regulator and the things that we are seeing evolving in this interesting and exciting landscape.
Wailum,
Coach.
sorry to interrupt again. Your sound went off for 10 seconds.
Okay, I'll try again. Whenever you let me, whenever that happens, just let me know.
Sure.
So I will start off with a high-level overview of the approach of how our approach to regulating this space has evolved. The approach, or for that matter, they only focus on AML CFT issues. But for us, we took a very deliberate decision to want to regulate this space very early on because we took the view that
Excuse me, is it just me or we cannot hear Wailum?
Well, we lost you, Wailum.
Wailum, we've lost you for quite a long time. I think there's only like 5 seconds where we hear you, and then we cannot hear you for 10 seconds. I don't know if it's the microphone or some interference. I don't know if there's a way how to change maybe your audio or.
Let me change my audio to something which is not to speakers.
No worries. But
how about this?
We would prefer to hear you, so that's why we stopped it. Sorry.
Can you hear me now?
Yes.
Okay.
Nope, we can't hear you again.
No, we cannot hear you again for some reason. I don't know why. Would it be helpful if we share the presentation on our site and you are not sharing the screen? Maybe there's a bandwidth problem.
I doubt.
Or maybe don't even share the screen. You can just present with just talk without sharing the screen. Let's try if that helps. Maybe with the issue.
Okay. I just changed my setting one more time. Let's go with one last time and see whether it works right.
Perfect.
So I was talking about being a regulatory pioneer comes with risks because back then, when we look around the world, there are probably only 2 regulators in the world that has done so. And one of them is Japan. The other one is New York State of Financial Services. But even then, the landscape wasn't very developed. The regulatory thinking wasn't very developed. The focus was very much AML, CFT risks. But when we spoke to various stakeholders, we come to realize actually the risks are a lot more comprehensive and than just AML, financial crime risk. You have the traditional financial risk that are related to safe custody of client assets, market abuse, integrity provisions, investor protection considerations, technology governance, so on and so forth, right? So eventually we went with this idea that, look, it's going to be very similar at some point in time, a convergence between the DeFi space and the TradFi space. So, and being the first mover, we need to be stringent from day one. And we ended up actually just extending our securities regulations from what is typically securities and derivatives to carve in digital assets as just another asset class. So if you are a digital asset service provider operating like an exchange, we will regulate you like an exchange. If you are a broker-dealer, we regulate you like a broker. Or any other types of intermediary like custodians, fund managers, so on and so forth. We regulate you as if you are like a TradFi player. So that was a deliberate decision from day one. And since we adopted that approach, I think we've seen three broad phases of players coming in. Very early on, the first batch of people coming in were very much those players looking for price discovery. So you have the exchanges, you have the broker-dealers allowing on and off ramping. And then the next phase of people coming in are very much the institutional grade custodian standalone players. And when FTX hit, it accelerated that development, and we see a lot more of such players coming in. And more recently, in the last 12 months or so, once you have price discovery, once you are able to protect the assets properly, the investors are starting to look for yield from their assets. That would include staking, that would include yield farming, so on and so forth. So today in our ecosystem, we are starting to see some of these players are looking to generate seeking yield in our center. Now, that last 6 years or so, what has really changed? We might have become a lot sophisticated in terms of regulating this space, but certain things are constant. We realize that we still need to offer very clear regulations and rules. Regulatory clarity and certainty is key to the development of this space. So we might be tweaking our rules to simplify, or we might be adding rules or enhancing our rules to address specific risks. But by and large, we want to go out there to provide as much certainty as possible to the industry. And as we start to deal with more players that are coming in from a global landscape, we find that we actually have to deal a lot more with international regulators as well. And there's also the question of how regulators work with each other to achieve regulatory convergence. There are a few platforms for us. ADGM is one of the members of IOSCO, the global standard setting bodies. We are also members of BCBS. And platforms like that allows various regulators to come together to discuss the principles, to set standards around regulating this space is starting to become more developed and more frequent. Right? But there is some constraint to this, right? Because each regulator today are still starting at different points in time, different stages of development, and there are different priorities and circumstances. So you find that in order for you to come to a sort of a convergence or common perspective, the discussions tend to be rather high level. And because of that, we might not be able to come up with very detailed standards at this point in time. Right? So there's the constraint of multilateral platforms. In experience, we find that bilateral collaboration between regulator to regulator sometimes achieve much more than the multilateral platforms. And of course, a smaller group means that we are more agile. Let me give an example. We have industry players coming to us to suggest that they want to be able to deploy this product in these two jurisdictions. So with that, we actually started to contact an overseas regulator and have the conversations, and we do POCs, test their solutions. And because of that, that VASP is able to have more aligned conversations with two regulators on a smaller scale. An example was we have this firm in our sandbox. They had a technology that's able to program compliance to move tokens in compliant fashion and store tokens in a compliant fashion. And their backer, which is WisdomTree, they wanted to tokenize their ETFs in the US market. But somehow there wasn't, it was something which is still pretty new in concept in the US market. So this firm came to us in our sandbox, and through us, we actually started the conversation with US SEC. And because of that collaboration, US SEC got to know about the technology a lot better. And we are glad to say that as an outcome, WisdomTree finally registered their tokenized ETFs end of December 2022. So that was a very good outcome from collaboration. And finally,
what I'm hearing is that you actually play a role as a promoter of blockchain technology, as a regulator, and helped indeed the SEC to understand that project in particular better, to be able to regulate that and to get them a license. Is that correct?
Yes. Of course, we are not the one telling the story. It is the firm themselves explaining to SEC, right? But the conversation started because of that. So we are very happy to be able to help.
As you move to the constraints, Wilem, I can see a couple of questions that will relate to your final bullet on this slide. Sure. Perhaps you can, as you talk about the constraints and regulatory challenges, can you also elaborate a little bit as to how does ADGM plan to maintain regulatory relevance without stifling the inherently trustless, borderless, and permissionless innovations? And perhaps how can you, as a regulator and a pioneer regulator, or amongst the first ones to have a comprehensive regulatory framework, how do you maintain leadership in the future?
Very, very good questions, and very thought-provoking as well. We are a new financial center. We are a new startup regulator, so to speak. So I suppose that is an advantage to us in terms of us being agile in our rules and regulations. Now, the constraint is, even at the end of the day, we are at this point a small regulator. We have a modest conception of how much we can influence the global dialogue, right? At the end of the day, the big international centers like the London, the Europe, Paris, or the US, Hong Kong, Singapore, at international forums, they are ultimately the key drivers of developments, right? But that hasn't stopped us from trying to do our part in helping bona fide players who seriously want to create an impact to come to us. So today we offer that opportunity, and to maintain that thought leadership, right? Let me just move on to the next slide. Yeah, we continue to develop rules and regulations as we interact and engage with new business models. So one very important means for us to keep ahead of the curve and be relevant is to continue to upgrade our rules and regulations as the activities start coming in. Just to give an example, right? Today, we actually have a fund management framework that allows VA managers to invest in all sorts of tokens, whether it's securities tokens, or whether it's utility tokens, or whether it's SaaS, or whether it is token warrants, so on and so forth. And those kind of framework comes with somewhat detailed study of our understanding of how these tokens work. So that's for the fund management side. More recently, we allowed the first stablecoin issuer in our center, which is yield-bearing, and which is a slight deviation from what we see around the world, which today allow stablecoins not to pass on any yield savings to the token holders. But we took the view that, look, if it can continue to function as an effective means of payment for the unserved, unbanked, for example, in the LATAM markets or in the African markets, where today the underserved population is still pretty big. We think stable coins like that, even with a yield, where out of goodwill, the issuer is able to pass on any savings from their reserve management to the holder, it benefits the consumers. So from that starting point, we think there's no reason that we should prohibit stable coins from generating yield, right? As long as we are able to monitor at any point in time, the reserves backing the value of the coin is there, right? So I think things like that, we try to still push the boundary, while at the same time listening to what's happening out there in the regulatory community, right? So stablecoin is one of them, one example. Another thing that we're trying to do now is to look at virtual asset borrowing and lending framework. There are prime brokers out there that are looking to support this space, especially with the number of hedge fund managers that are coming into the center. So again, I think as a regulator, having a framework around VA lending and borrowing will definitely support the development of the ecosystem. So that is from a regulatory perspective, coming out with rules and regulations. But while we do that, we must also be able to inspire confidence that we are able to supervise such developments. And from our perspective, the best way to supervise technology is using technology. Just to give an example, in our sandbox in the past, we just focused on helping them navigate their rules and regulations, and from there, make informed choices of how to tweak our rules and regulations. But today, when we make use of the sandbox, we also make sure we develop the supervisory capabilities along the way. Today, we do have a firm that is from Coinbase Asset Management in our sandbox. You might have heard of Project Diamond. So they are offering discounted coupons using smart contracts in our sandbox. But as we test and monitor their flows, including automated coupon payments, we start to build our dashboard of supervisory monitoring, where we are able to see the on-chain activities. At the same time, we try to be able to see how while we're monitoring the on-chain capabilities, we also pull the APIs from the various custody players to see that fiat world and the crypto world sort of match each other, right? So technology capabilities like that we develop along the way so that we can inspire confidence when we interact with fellow regulators around the world.
Thank you, Wailum. Before we move on to Ronald, perhaps you can tell us precisely what the future would look like from the ADGM perspective.
Yes, so very exciting to us in this space. We do see that there is going to be greater institutional adoption, the convergence between the TradFi space and the digital asset space. I mentioned about hedge funds in here, we talk about stablecoin issuers. We are also starting to see institutional market makers. That's where the prime booking models are starting to come in. And really, for us, new space, but we are not starting from scratch. We are able to draw lessons from our experience in regulating the TradFi space. And I think our experience has suggested that it makes sense for us to use that as a starting point and see how we can evolve and adapt our approach to regulate this space.
Well, thank you very much, Wailum, and wishing you all the best for the next few years to maintain the very pioneering position of ADGM in the global markets. Ronald, perhaps you can take over and tell us now what the regulatory landscape looks like in Switzerland and how the regulator is thinking about moving ahead.
Yeah, sure. So I think beginning, it's important for people to understand that Switzerland follows a bit a different system, which means that we have a financial market regulator that supervises the financial markets and also the insurance market, which is called FINMA. But the regulator in Switzerland is not creating regulations. It's just like executing. So it's an execution body. And this is, of course, based on the principles of checks and balances, which means that any regulation or law is enacted through the parliament, which is basically a separate body as a counterbalance. So it's a legislative body. And because of that, in Switzerland, it would not be the regulator that is saying how something is regulated because they're just applying. And based on that concept, Switzerland started quite early with seeing the potential of the technology. So as said, I mean, Ethereum guys came to Switzerland in around 12, 13. Then Ethereum has been established in 14. And already at that time, the Federal Council issued a report on virtual currencies where they basically acknowledged the potential and also try to do a first qualification on the law. And if I talk about laws, it means basically it can be civil law, it can be public law, but it can also be financial market law. And then basically in 2016-17, the ICO wave hit Switzerland. So we had thousands of ICOs, also many of the biggest ones. So like Tezos, Near, as said before, Ethereum, Cardano, and many others. And at that time, the regulator then, which is FINMA, invited market participants for a roundtable to understand what they're doing. So to understand, is the sale of tokens falling under financial market law or not? So is it basically under their supervision or not? And then based on that, they issued an ICO guidelines, which was, I think, something very new all around the world, because it was the first time that the regulator is qualifying tokens. And there, basically, they defined that there is a distinction between security tokens, utility token, and payment tokens as a general category. And they also made clear that pure utility tokens and payment tokens are not securities, and that pure utility tokens are outside of financial market law and are neither a payment instrument or anything else. And I think that guidance was very helpful because it also made it clear on how you can legally issue a token under Swiss law. And then, of course, everything evolved further and the regulator stayed very active, but also the parliament, so the legislative stayed very active, and they have seen that a lot of things came into Switzerland, that also financial market players started to engage with the technology, but also pharma industry and others. So they assessed all laws, including civil law, code of obligations, financial market law, to assess whether there is a need to adjust the laws for the benefit of blockchain technology, that the technology can thrive. And as most of Swiss law are basically drafted technology neutral, which means they are based on principles, many of the laws can just be applied also to this new technology because it's just a principle whether it's fulfilled or not. But nevertheless, there were some adjustments that have been made. For example, it has been made clear that the tokenization of financial instruments is possible, that the token itself can represent equity, debt, or whatever. It also has been made clear that, for example, if someone is doing custody for digital assets, that these digital assets, if they are segregated, they are protected from bankruptcy. So by this revision, basically, the Swiss jurisdiction tried to make it even more clear for people that they understand how the rules apply, how they can establish a business, whether it's custody, whether it's brokerage, whether it's issuing tokenized shares or whatever, so that we have a clear framework that it's easier for market participants to enter into the space. And what we have seen over these years is, of course, that also from the financial market side, a lot of players came into the space. So we have 2 fully crypto banks in Switzerland, which are born out of crypto. And meanwhile, we have around, I would say, 25 banks that offer to their clients direct access to digital assets, including cantonal banks. And by this, basically, crypto is becoming more and more mainstream. And of course, next to that, you have all the initiatives like the Crypto Valley, you have the Plan B in Lugano, so where you can also start paying in crypto to authorities. So in Zug, you can pay tax bills in crypto, etc., etc. Of course, Switzerland not stopped in moving forward. I mean, it's always a balancing act between allowing innovation, but also jump in when it's the right time. And as said before, the Financial Market Supervisory Authority, FINMA, they are not allowed to enact laws, but of course they can publish papers where they state their practice, as they have did with the tokens. And they did that at the end of 2023 again in connection with staking, where they basically made clear that, for example, if a bank or a financial intermediary is offering staking services, what they have to fulfill if they outsource the node operation, that the assets are still protected in case of a bankruptcy. And I think that was an important guidance, because it was also very technical, but especially if you look at Ethereum, which is basically not a delegated proof of stake network, but is a proof of stake network that you really need to make sure that the technical setup is right, that the staking provider still keeps control over the digital assets. So this was also a very good guidance to make sure that if banks and financial intermediaries want to offer staking services, they can do that in a legally compliant way. And even for the financial market participants, so the investors, they are protected by insolvency protection. Then the newest guidance that have been issued in 2024 is a bit more controversial because, of course, Switzerland is a country which has a very high level of integrity and also of compliance. So Switzerland is also implementing FATF guidance quite early, which means that they also have issued the guidance on stable coins. And there, basically, the regulator made clear that stable coins are similar to banking deposits, so bearer claims. And that also means that every transaction on the blockchain needs to be subject to KYC AML or whitelisted addresses. Because otherwise, they said stablecoins are basically prone for money laundering or terrorist financing, because so bad actors can just buy them, transact, and then the redemption is done again by someone who has a clean sheet. And this guidance is, of course, not much appreciated by a lot of people in the industry. Of course, you can say that because of the guidance, it's a question whether blockchain technology and stablecoins make sense at all, because if you have to KYC everyone on a secondary market, you can just use an Excel sheet. But it seems that this is all coming from FATF, so I'm pretty sure other countries will follow on that. So that's something that will be interesting to see. So going more into an outlook, what will happen in Switzerland. So Switzerland is currently thinking about how an additional license can be introduced for specifically payment business models and also stablecoin business models. So they want to make sure that there is also additional licensing regime available to people that want to fully focus on Web3 technology. And on the other hand, I think there are also initiatives and also based on international initiatives, especially IOSCO, on how DeFi shall be regulated, if it is regulated at all. But I think that will be then also a very important milestone, because it will provide clarity how you can do a DeFi project either in a regulated way or how you can stay unregulated. And that will be something which will come up likely in 2025. So it's going to be an interesting year, but I think all will be to the extent possible for the benefit of the blockchain technology.
Well, thank you very much, Ronald. I think that was a very comprehensive overview of what has been done, what is done today, and future outlook, specifically looking at regulating or not DeFi, which is a very contentious point globally. Thank you very much for this presentation about Switzerland. Wailum, thank you again for presenting the regulatory landscape in ADGM earlier on during this conversation. Perhaps I'm gonna, if Greg has joined as well the call, I would like to invite now our three next speakers, Paolo, Miguel, and Greg. I would like you perhaps to take the floor, introduce yourselves very briefly before I ask you the first question. So in the order of appearance on my screen, I see Miguel first, so perhaps you can go, and then Greg, and then Paolo. Thank you.
Excellent. Thanks for the invite. Looking forward to the discussion. I'm Miguel Vaz. I'm Managing Director for Digital Asset Custody. We have a German license from BaFin to do this, and we do this within a private bank, a very old, very traditional private bank, but very innovative at the same time. And we're mostly known for the work that we've done in tokenization. So we did a bond with Siemens last year on Polygon. And we also have a setup where fully regulated funds can invest in cryptocurrencies and have a one-stop shop solution for ourselves. So my focus is custody. That's where my strongest opinions come from, but I'm happy for the overlap with the fellow panelists.
Thank you, Miguel. Greg.
Yes, hello. Thank you, everyone, for joining. My name is Greg Signorelli. I'm head of Americas at Tokeny. We are a 7-year-old company headquartered in Luxembourg. We provide blockchain solutions technology to financial institutions that we believe truly functions as an on-chain operating system with at its core the ability to issue, manage, and distribute security tokens on a public or private blockchain that are enhanced by built-in compliance control rules along with an on-chain investor identifier. By way of background, I spent quite a number of years, a total of which I'd rather not count, in sales and trading in the capital markets divisions of several tier 1 banks. Fixed income was my specialty with an emphasis in debt underwriting, portfolio construction, derivatives hedging, structured products, and also countless hours lost managing highly inefficient post-trade settlement issues such as trade breaks, reconciliations, booking errors, so on and so forth. So it was around 2020 where I kind of gave up the trading floor and shortly thereafter joined a fintech as I found blockchain, distributed ledger technology, and frankly, the value proposition of asset tokenization and what its promise can bring just too attractive not to get involved.
Thank you very much, Greg, for this comprehensive intro. Paolo.
Yeah, thank you, first of all, for having invited us to participate to this panel. Myself, I'm responsible for the commercial side of Funds DLT, also one of the founders back in 2020. As a company, we are based in Luxembourg, and we are focused on investment funds and the tokenization investment funds back from 2016 when we started and we did the first ever transaction over the blockchain for investment funds. Since then, so we have evolved. We initiated the project into a market infrastructure with the Luxembourg Stock Exchange. And since then, we spinned off the project into a company that is then been held by the market at the first stage. And now today we belong completely from Deutsche Börse.
Okay, so with ties to Germany.
More international, not really.
Of course. My first question is, how do you, all of you, deal with regulation and the challenges when it comes to your operations and the specific service that your companies provide? So perhaps we can go around the table again and start with Miguel.
How do we deal with regulations? So first and foremost, it's what gives us our raison d'être, so to say. It's the reason why we exist. So it's incredibly important. It's incredibly important to have a clear value and ownership chain in the digital asset space, so that we can have a proper setup and know what happens in each scenario. So bankruptcy being one of the most important but least talked about cases. In our case, it's interesting because it's a mixture of old regulations, so regulation that applies to all of the financial services, and new regulation that is very sometimes very unclear, but is something that we deal with mostly in dialogue with regulators. So it's dealing in dialogue with associations such as INATBA, dealing with our peers, so that the space is incredibly cooperative. And what we do in those dialogues is mostly trying to figure out what was the goal, what's the purpose of the regulation, and how we're going to put up the business practices so that we can comply to that. So I'm not sure if that's the angle that you were hoping for, Izat, but that's the answer that I would have.
Well, what I'm hearing is that you're not trying to circumvent it, and that's all we want to hear, right? That regulation is good to have. It's a rule of books. You have to read it, you have to comply with it, and it can be an innovation enabler in some shape or form, and that some of the rules are growing, but without suffocating the R&D in the industry. That's all we want, right? And my personal view, not INATBA as an institution view, but you will see that we all say the same thing, is that some regulation is better than no regulation, and smart regulation is what we all want from the regulators. And we have heard some about some very smart regulators earlier on during this conversation. Greg, how do you handle the challenges linked to being compliant?
Right. Well, we actually, handle it or deal with it pretty straightforward, pretty head on. The basis of technology for asset tokenization, its foundation is on the ERC 3643 standard, which we developed a few years back. A not-for-profit association was founded to promote the broad use of such a standard, because we know if we have broad use, then we coalesce around a standard, then all boats would hopefully rise over time as we have broad market adoption. But the main thrust of 3643 protocol is compliance and control. So issuers have control over the tokens insofar as investor distribution and asset transfers and so on, but also compliance rules. Now, we're agnostic on jurisdiction for asset tokenization anywhere around the world, but it's quite firmly built into the protocol that security tokens, which, if you think about the off-chain security world versus on-chain, rules of the road still apply. So it's very, very important to keep the regulator happy when our issuer clients are bringing assets to market. These are, at the end of the day, security tokens. So it's very important, and what was quite central to the development of the ERC 3643 is the ability to apply said compliance rules of any regulator in any jurisdiction around the world. So we do approach it head on. Now, from our issuer clients, and half my time is spent working with various RWA issuers from Canada, US, Mexico, and down south into Latin America. The very first thing we speak about with our clients is very much that very topic about, you're bringing security tokens to market. Are you working with securities attorneys? Are you following the rules of engagement per that regulator? So we look at it very head on. Now, that's for the RWA asset tokenization side. Now, bifurcate that and now start thinking about the other work that we're doing with the tier one financial institutions, when we're looking at infrastructure changes and how they're going to approach this market. Obviously, they're moving a little bit more cautiously, because in the US, at least, regulations are in how we deal with crypto and blockchain and all things having to do with DeFi. It's still a little bit up in the air, and everyone's approaching it cautiously. But at least it certainly feels that many of these largest banks and asset managers have real staff in place. They are working on it, and they're trying to build the road or the runway such that when there's better clarity from the regulator, they can then take off. So I would say here in the US and in Canada, and I could even say for some of the other regulators south of America, that they are addressing it, and that they are working toward building solutions such that when that time comes, can't predict that. We have a big election coming up here in the States as well. So 2 years, 3 years, it's hard to really say, but I think the horse is out of the barn, as it were. And the largest institutions are realizing that if they don't get involved now, trying to catch up later is going to be difficult.
Thank you very much. And I'm sure it must be very trying to be in a place where there is no regulation, and how to be as compliant as one can be by not reinventing the wheel, but also trying to predict some of the risks that you're going to be facing when regulation appears, right?
Yeah, indeed. Indeed.
Paolo, perhaps you can enlighten us as to how you deal with regulatory landscapes in all the places where you guys do business.
Yeah, and first of all, of course, being in Luxembourg, Luxembourg has created over the years a very strong and compelling framework for tokenization, starting back in 2019. They produce today 3 laws, and now there is also a 4th draft law that will come very soon. Nevertheless, again, we work on the fund industry and more precisely into a framework that is considered outside of the blockchain laws, because in the end we fall more into normal standard laws that applies, like UCITS laws and MiFID as well, and others. So in order to come to the market with the solution that are viable today, of course, we have to comply with existing rules and regulation. The Luxembourg regulator and legislation also pretend to be neutral for that, and so all other laws applies. Say that we had to take different license in order to operate, and several licenses in order to provide our services, whether it's SaaS service, software as a service. And today with the DORA, it's even more important that we comply and we are able to have the appropriate license in order to cooperate and work with financial institutions. From Luxembourg, we offer service in other markets and other jurisdictions. So we also had to deal with different jurisdictions. We face the fact that probably there is not an harmonized environment yet in Europe. And beyond Europe, of course, we have to carefully consider where we go and do a sort of important and consistent due diligence in order to see whether we can offer and provide service. I think that's our situation for the time being. It's true that for a fintech, being heavily regulated costs a lot and have to be taken into consideration.
I would like to throw at you, and I will leave the 3 of you to decide who would like to go first. I would like to ask you 2 questions. My first one is more of a business oriented. What are the opportunities created by the technical ability to tokenize money and real world assets? That's number 1. But in the wider landscape of an ever-evolving regulation that is tightening in some places, and where we hear that other regulators have a different view, that they almost try to neutralize technology, as we have heard Wailum allude to that earlier during our conversation in ADGM in particular. How do you position the business opportunity, being high, being low, and what would you see as being hurdles to the business models that you guys are developing through your companies, right? Or opportunities for that matter, if we see the glass half full.
Well, I guess I can go first. So starting at the last point, we tend to approach this market in a very optimistic way. As I've said earlier, when it comes to DeFi and blockchain technology and distributed ledger technology, as I said before, the horse is out of the barn, right? We see tremendous advancements over the last few years by very large tier 1 regulated institutions, right? As I mentioned, that they're approaching it cautiously, but as we've seen from some of these largest issuers, they are testing the waters, right? I mean, you've seen what BlackRock's done for like Franklin Templeton. Many of these large institutions are approaching it cautiously and determining what is the right path forward in order to do so safely. I think what in the US is always a fear of some forensic regulator coming back after the fact and determining that what was done was not proper, not correct. So there's always a little bit of fear. But when it comes to the RWA side, the broad use cases that we're engaged with, and just frankly how it feels almost like a parabolic type of move over the last year, from all forms of different issuers, as I said, in the US, Mexico, and Brazil in particular, those 2 countries rather. But then in Guatemala, in Chile, in Colombia, in Canada, and of course the US, there are many different use cases of issuers who are trying to bring their assets to market and are looking at this technology as a way to broadly distribute the assets in a more efficient way to operate those assets when it comes to, for instance, revenue distribution. If you're looking at use cases like commercial real estate or mining rights or intellectual property and all these various use cases, it feels in the last 6 months or even a year, these various asset owners are looking to broaden their investor base. Private equity, of course, to some degree as well, but some of these other, and we call this real world type assets, the volume just continues to increase. And happy to say that Token has been at the heart of all this, and we have many of these issuers reaching out to us to try to utilize our technology, because at the end of the day, they do care quite a bit on control and embedding all the securities compliance rules that are required for their issuance. They understand that they need to follow the law, and they intend to do so.
Thank you. There is a question in the chat. Perhaps we can take that before Miguel and Paolo answer as well my very large question. The question in the chat is, how do you value or assay real-world assets in a digital environment and deal with the changing values? Or are you just introducing a new layer of middleman consultants?
Okay, well, I'll take that as well. So, listen, we're talking about, for the most part, at least in today's world, these are largely private market assets. I gave a few use cases earlier, but in the private market space, valuation has always been challenging, right? In many of these formats, in an SPV type of a structure, you have a GP, a general partner, and a limited partner, and the GP tends to have a, closer finger to the pulse, if you will, on the asset value. And at least utilizing our technology, we allow the issuer on his basis to change the valuation as he sees fit. But these tend, at least in today's market, these tend not to be incredibly liquid, right? We know this. This is the unfortunate world of private market securities, which is in the multi trillions. We try to put a fixed number. It is a little bit difficult, but part of the promise of asset tokenization and democratization and distribution in a very compliant way, let's be clear on that. The intent is to build a secondary market, and then I believe, and more importantly, a collateralized lending market. Well, all that is predicated on a proper evaluation. Some investors think that all of a sudden, because it's tokenized, it's going to automatically create a liquid market, and that's really not the case. Ultimately, it is providing an infrastructure that allows it, whereas we know today the private markets have very, very little in the way of capacity for secondary market trading, and next to nothing in the world of collateralized lending. In many cases, it will still require the GP to put valuations on it so that some potential buyer in the secondary market at least has some form of bona fide truth of what the value of the underlying asset is.
Thank you very much. Miguel, would you like to address my question that I asked Greg earlier, and perhaps talk about challenges, opportunities in terms of business, and what it means, what the existence of regulation means for your specific business in terms of custody, and what it means in terms of what the future would look like?
Happy to, and I would like to make a bridge to the question that was posed in the forum as well, because we're still very broad in our discussion, right? So I think I have a bit of a broader scope than the colleagues in the panel, because as a license provider that holds digital assets, first and foremost, I don't care about what the assets represent. I just care that they're digital. So that's the first aspect. And when we look at business, I think it's fair to point that in 15 years of blockchain at the moment, we only have, at the level of the assets, we only have one innovation. There's only something new that was created, and that's the cryptocurrency, an asset that doesn't have a formal issuer. So that's the innovation. So when we talk about valuation, the assets, a fund is still a fund and will remain a fund. A bond is still a bond and will remain a bond. And our job in the financial industry is to make sure that we can issue them, make them investable and transferable, right? So that's more or less our mandate here. obviously, and safekeeping them in the meantime before it's moved around. Obviously, that's my focus. Now, whenever we talk about business and within that mandate, we have to ask the question, which assets and where, because a bond is heavily regulated, a fund is heavily regulated, and there's good reasons for that, because we want to make sure that there's a clear chain of control and there's a proper dealing with good and bad situations. And what I see is that we still have to deal with very specific local markets. And there's, for example, when we look at one of our growth vectors, which is the electronic securities in Germany, it's still a very local regulation. So it was something that was created for Germany, is valid in Germany, has provided some clarity, is a growth market. Also, I know that Tokeny is involved in some of the projects, and also the standard has provided some guidance there. But the role of custody is also very clearly defined and very small. I think that in order to make this form of representing and holding and transferring the assets the new way further, I think we need a bit more work. So to continue the work that we're dealing with and we're doing every day, so that we can have, for a lot of assets, that we can have clear guidance on how to perform investment, issuance, custody, and transfer. I think that's the biggest thing. And we know that it's hard, but that's the end game, right? So that's cryptocurrencies are a niche. That's the big game. So what we want is real world assets, and we want to create investment vehicles where we can actually have an exposure to them. In the meantime, from the custody perspective and also from digital asset perspective, I think it would be irresponsible to ignore two major things. So the first one is the maturity in the crypto asset markets. So where we have stuff coming out of the unregulated or not clearly defined markets, such as the cryptocurrencies, or from the DeFi space. So that's point number one. We have created funds within the bank that allow us to allow investors to have an exposure to a diversified portfolio of these things. And the second one that I see, and that's more related to transaction and the function of transferring value, it's what regulation is going to give us as a present from 2026 on already now, but from 2026 on, is that we will be able to say things like, well, the container is in Rotterdam, or the container is in Barcelona, and to have a clear safety and trust behind those statements that you can then use in order to create automatic changes of value. So create payments and make sure that the digitization of trade finance, for example, which was something that been working this for quite some time. Some of the use cases that we were hearing in 2016, 17, 18. I think that these items, through the digital product pass that is being launched in the EU, and that has a universal impact, I think that's one of the growth vectors that we're going to see. And I think that's pretty exciting. Also, the retail markets associated to that, with respect to marketing, are also very interesting. So I think the big end game is a patience game, and I think we need to continue working on that. I think in the meantime, there are a lot of opportunities where we can mature our processes and profit from the fact that new growing businesses are existing and are forming as we speak.
Thank you very much, Miguel, for this comprehensive sharing your opinions and your views on the future and how it appeals to the market and what is left to do, most importantly, right? The ground to cover.
Absolutely.
Paolo.
Yeah, I want also to link to Miguel's comments, because true that investment funds are very heavily regulated. And the second point that probably Miguel was mentioning is very important, that true that as well, that today the issuance of regulated products on a tokenized form is lagging in the market at the moment. So from the issuing side, I would say that we see that there is an interest for improving. Nevertheless, what we see from the asset management community that we want to serve still is missing and lagging a bit the business case behind. Okay, launching a new funds for just testing the different chains and operational model is already done almost in 2023, sorry. We see several proof of concept and live use cases. In 2024, the market is much more calm in that respect because probably from technology perspective, many things have been already proved. Now it's really lagging a bit the business case. And so we see the tentative today, for instance, to move into, I'll say, a business opportunity use case, value use case, like money market funds tokenization. We see in different conferences talking about that, and mainly for collateralization. So the industry see mainly that has a potential use case to start from. It should be known that, of course, in that respect, it's a bit, and then we see the interest from the market for the, I would say, secondary market type of approach. Okay. And the secondary market approach from a business perspective is more related to try to find another channel for distributing products and nothing else. While for us, from our point of view, the value from the blockchain technology is really to create much more synergy and efficiency between existing distributors and these existing actors that serve the market and provide the product to the markets. And this point probably is less interesting from the asset management perspective that already have the trade fin, call it in that way, but it's the traditional business, and they already is sufficiently efficient today to reach the investors. We try to talk to our market, to the asset management community, to link to custodian on the digital custodian side in order to provide them both sides linking together. And it's not a use case that really find appetite from the industry today. That's a bit a pity.
Yeah.
Perhaps I can ask you the two follow-up questions from the chat before we move to the conclusion of this panel discussion. So the two follow-up questions are, what platforms do the panel believe have the ability to scale and last long-term to implement these projects in the end game? Are we going to take that? And then there's a second follow-up question, and then we move on to the conclusion.
I can start first because I'm not really an opinion on that. It's difficult to predict today. I just tend to say one thing. I was reading a few days ago the ECB comment from the ECB that it was talking about rails. Okay, the need for having rails around Europe. I fully understand that there is a rails, but even them, they were saying they have no opinion which one will be the most relevant one. And I think this complexifies the adoption and the business grow over this new technology and the new rails, because the rails still are, I would say that we now wait for someone else taking the lead on creating these rails, and then the rest of the actors can link and can really connect to that. And unfortunately, I would say that if we still wait for something that will happen, it's creating what I see today, that the technology is already proved, but the business is not really moving on into these new rails, in this new environment.
Okay. What about you, Greg and Miguel, about the question on what platforms do the panels believe have the ability to scale and last long-term to implement these projects?
It depends on what you mean by platform, right? So I think let me state a couple of requirements. I'm not going to endorse any specific platform, especially because there's so much movement in the public chains. So the chains that we would like from the point of view of distribution of assets and accessibility of information, those would be the most interesting. But there are two tectonic forces in play here. So we have the tectonic force of innovation, and the tectonic force of innovation is the one that will allow us for the complete value chain to be represented digitally. So that's vector number one. Can I have digital custody? Can I have digital issuance? Can I have a digital secondary market? Can I put all of these in a way that is safe and secure from the transactional point of view? So those are the public chains. Those are the ones that are actually offering and developing the standards and innovation. And the second one is from the point of view of risk management. There is clear guidance from Basel, at least for regulated banks, that kind of from the point of view of business points us into the direction of not having necessarily interaction with public chains, but more or less having them at a private permission setup. So we had these discussions 7 years ago. These discussions are back on the table. I think it's fair to say that there are risks. Sadly, we don't have a way of managing the risks ourselves, except for having a high level of collateral, of tier one equity put aside in order to handle them. So I think those are the two vectors that we will see in growth. From the point of view of requirements, technically, I look more at the EVM standards that have, so Ethereum virtual machine standards that have a way for us to deal with stuff like wallet abstraction. So that have a wallet that allows me, for example, to do segregation of funds. So separating operations from the custody account of the investor. So those are from the technical merits. Those would be the ones that I would highlight. And I don't know, Greg, what you think and what you would like to add to that.
I think to kind of echo a little bit of what you said right from the beginning, it's very difficult to put a definition on platforms. What do we mean by platforms? I think, I'm obviously going to be biased when it comes to the platforms that Tokeny offers for, asset tokenization and so on, but that's obvious. That's what I'm going to endorse. And I think we're here for the long term. But when we think about platforms, at least given my background, when I think about platforms, I think about distribution platforms. I think about secondary market trading, but also primary market distribution. There's always the potential for that. And I think one of the things that we hear so much from issuers is that they're looking for tapping into new forms of investors, not just the ones that they have, but be able to use other distribution partners to broaden the investor appeal. And I think there it becomes a little bit tricky, just to kind of state it clearly, as I see it, asset tokenization, as we know, as we've certainly been talking about, it challenges the status quo of traditional finance, which I think is a good thing. I think it's long overdue. The end result, ideally, is to increase the utility of assets while simultaneously decreasing the operational friction in TradFi, which, as I mentioned in the beginning, it's kind of long of what I've had to deal with in my prior career. But to be clear, tokenization offers a tech solution to an inefficient market, but it does not, by definition, offer unchecked democratization, as asset transfer rules, for example, based on the regulations in that jurisdiction, will always remain firmly in place. So it's hard to see today that secondary market or collateralized lending platform that exists in the marketplace that is going to deliver to that promise. Those that solve it and are able to create it based on what we get in regulation, determined over the next couple of years, those I think are going to survive in the long term. The idea of how do we reach clients on a global scale, investors that want access to private market securities that they don't necessarily have access to today, those platforms that are able to find that and distribute it are going to survive in the long term, and they're going to achieve scale. We have technology that's built within Tokeny called Arduino Network that is meant to facilitate that and allow that connectivity to various distribution partners, but that's going to really take time to flush out. So it's kind of a weak answer, mainly because it's really too early to tell who's going to get scale and who's going to have survivability.
Yeah. Thank you very much. And thank you for addressing indirectly the follow-up questions on tokenization as a service and what are the criteria to evaluate the robustness and the viability and the durability of the platforms offering solutions such as the companies that are represented here in this panel. Now, as a conclusion, I would like you perhaps to wrap up and think in terms of think about it as a advice, kind, humble, you would give to a regulator as to what you would like to see come out in the next, let's say, 18 to 36 months to help enable the ecosystem to keep growing, but in the safest and the most sustainable way.
That's the challenge, right? That's difficult to answer in terms of what type of advice. Listen, I think again, there's been a lot of frustration here in the U.S., especially around the regulators, and then of course, the political landscape is a little indeterminate right now. I still will say, in defense of regulators, they have a very difficult task at hand. One of the concerns always has been in place in the age of crypto, especially, is it's twofold. One, you have to ensure that bad actors are not taking advantage of this ecosystem and being able to do things that they otherwise couldn't do in the traditional banking market. So that is a greater concern. But I think the regulators are also primarily concerned about and protecting of the investor base. That's almost their primary duty, to focus on that. Mistakes have been made in the past. FTX is a classic one, that they want to ensure that these things don't happen again. So, listen, I'm not going to give advice. I think that's the last thing that I have the capability of doing, to be perfectly blunt. But I think action is needed. Again, I'm speaking from the firsthand experience of being in the States. I think the growing frustration is, as I said before, we talk about forensic regulation. Well, it's, you don't want to enforce by punishment, right? And it's always, a double-edged sword that we have to deal with here in the States. But, we have, I think the regulators have also been challenged because of the political landscape here in the U.S. And perhaps as we go into 2025, when it settles down in one direction or another, that there's a more of a safest approach. I mean, in the custody space, many have been waiting for this SAB 121 to be vetoed, and which I'm sure Miguel knows quite a bit from, in his seat, that it was essentially vetoed. So it basically had a regulator who was okay with it, but it got vetoed by the president. So, it's that type of movement that is quite frustrating in the marketplace to provide that type of clarity. So custodians are still, hands tied and not being able to provide the services that they do best in the marketplace. And if you don't have a qualified custodian ready to move forward, then you have institutions can't march forward because they have a responsibility and required to use custodians. So it's kind of like a chicken before the egg kind of a thing.
Well, thank you very much for your clear-cut answer. Miguel, would you like to offer some concluding remarks?
Sure. I think when I look at Europe, I think we don't have such a politicized spectrum as what you're explaining from the US, Greg. I think that's good. I think we're looking more into the substance of things. I see a couple of bottlenecks that I would like to have addressed, really. So the first one is that we still don't have a clear definition of what it means to hold the asset. It's still very based on myths about private keys and technology. And so I would, my wish list begins with let's have a definition of the functions of the different players and then decline the technology requirements from that. And let's start with the custody and transfer functions so that we can give Paolo and Greg a clear guidance on how they can set up their tokens so that they do have a secondary market to work with. And so I'm open to discuss definitions of custody with anyone, being task forces, working groups. So that's an invite to end my statement. Yeah.
Well, thank you, Miguel. The good news is that INATBA Finance Working Group is looking at those issues. I invite all the INATBA members on the call to reach out to Xenophon, JC, or myself. to express interest, because we will be trying to work on a paper precisely addressing those issues, but an industry position paper. We have discussed the possibility to invite non-members of INATBA to a joint task force. But first, we need to run this by the INATBA members. So if you're not a member, you know where to find us. Click on the form, apply to join. That was my 1-minute marketing before giving the final word to Paolo to close this panel session before we move on to the fireside chat with Lana, who has been waiting very patiently.
Yeah, no, very few words from my side, because of course I'm very close to, again, from the European environment with Miguel. Of course, we need much more clarity from an harmonization probably on the European level, first of all, on our core market. That allows to have a much more clarity. Many actors in the market are ready to move into the space, but still block for regulatory elements, knowing that actors are playing in multiple jurisdictions, and so they need really much more clarity, more harmonization between the different countries. And secondly, probably also acceleration on certain topics. You know, of course, we know that CBDC cannot be accelerated as we want, but there are other elements like the rails that the ECB was talking about. They should accelerate. The market is really ready to move. As I said before, experimentation, proof of works have already been done. It's a bit missing this, I would say, more institutional approach at the European level.
Well, thank you very much for your thoughts as well on the topic, and for what you wish to come out of from the EU institutions at the very least, and perhaps driving a global movement towards trying to give more clarity to custodians of digital assets. Thank you very much to the three of you for your time, for sharing your views, and for giving us more food for thought for the future. Without further ado, I would like to welcome my very dear colleague, Lana Schwarzman, who will introduce herself, and we can then carry on with a chat about the transfer of funds rules. Thank you. Lana.
Hi, thank you so much for having me. I'm excited to chat with you. Always a pleasure. Hello, everybody. I'm Lana Schwarzman. I am head of regulatory and compliance at Nota Bene. Nota Bene is the leading crypto pre-transaction risk company specializing in travel rule compliance that allows companies to stop potential illicit activity before it's settled on the blockchain. And prior to this role, I've been a chief compliance officer for 2 different crypto companies. I've spent almost 2 decades in compliance, and 13 of it has actually been in crypto compliance. I'm one of the OGs. I have also been in the advisory space for 7 years at Grant Thornton, advising some of the early crypto adopters on compliance and AML. And my early career days were Morgan Stanley and Deutsche Bank in various compliance roles. And I'm thrilled to be here today for our fireside chat.
Thank you, Lana. So now that everybody has grabbed a cup of coffee after lunch, perhaps you can tell us a little bit about what it means for the crypto ecosystem, please.
What travel rule means for the crypto
please.
ecosystem? Okay, sure. Yeah. So maybe we could take like a small step back and just to level set. I want to make sure everybody understands what the crypto travel rule is, and then what it means for the ecosystem as a whole. So travel rule is a regulatory framework that was initiated by the Financial Action Task Force in 2019. That requires virtual asset service providers to share specific transaction information between the originator and the beneficiary of the transaction to enhance anti-money laundering and counter-terrorist financing efforts. And it's essentially an adaptation of the fiat wire transfer rule, which has been the cornerstone in preventing money laundering and illicit activity in traditional finance probably for decades now. So before the travel rule, the issue in crypto has been that there was little to no checks performed when a CASP customer would send a transaction to a counterparty, and therefore the originating CASP, I would say, had very little to no visibility on who they were transacting with on the other side. And this always increased that inherent counterparty risk when it comes to sanctions and illicit transactions and high-risk activity. And now, when implemented correctly, the travel regulation is arguably revolutionary, because for the first time in crypto history, we have the ability to prevent potential illicit and sanctioned transactions from reaching the CASP before they're even created on the blockchain. And this gives CASP that power to reject such transactions, and thereby reducing this overall risk and exposure to sanctions, right? I think this is brilliant, actually. And really want to repeat that we have the ability to stop potential illicit transfers before they are created on the blockchain. And in the EU specifically, as you've alluded to, we have the transfer of funds regulations, which is applicable to all 27 member states, and it sets uniform travel rule regulation across them all. And then you have the accompanying European Banking Authority travel rule guidelines, right, from EBA. And if, like my team, you've delved into these regulations in exhaustive detail, you'll find that they are highly prescriptive, as they provide CASP with clear and specific instructions on how to achieve full compliance, which is being expected of all EU CASP by the 30th of December of this year. And Nota Bene, of course, provides tools and solutions that help crypto companies comply with this rule, making it easier for them to operate within the regulatory frameworks while still fostering innovation.
Thank you. How would you so let me ask my question a little bit differently. We see that there are many requirements in terms of compliance that the CASP have to comply with to be able to operate. What are the sanctions if they're not 100% compliant? So what is the risk, right, for lack of compliance? I think we can reiterate here what CASPs are at risk for. And then my second full question is, when we know that CASPs are global operators, right, multi-licensed most of the time, how do they deal with discrepancies in the obligation of compliance when it comes to TFR for crypto between jurisdictions, right? The EU has a uniform framework, but what about other jurisdictions where they would have to go? Does that, how do you deal with that?
Okay.
So first, what are the risks?
Let's break it down for me.
Yeah.
Okay.
So lack of compliance risk.
Yes.
How high the risk is, right? Is it just like $1,000 fine and can get away with murder, or not?
You definitely can't get away with
It's an easy one.
Yeah. And it's funny, sometimes this question does get asked. I think it's a not a common question, because hopefully most compliance officers and head of compliance that are generally responsible for this do have an understanding. I mean, listen, how's it with anything that if you are not in compliance with a particular regulation, what would happen, right? So you would look at different things. First of all, you would be expected that you would get fined. Generally speaking, it's usually fines that add up. They can be starting like daily fines, and then they would add up for whatever time period that the regulator would be looking at this. Then you would have probably a lot of reputational risk as well, because you're going to be named probably in an enforcement action that would also highlight what the fines are. So from that side, once you have reputational risk and you're listed in something like that, then it ultimately starts this ripple effect of negative news on the company, and which affects ultimately banking relationships, counterparty relationships. It just starts this negative ripple effect, I would say. And then there's a slew of other factors to start to consider. As compliance officers, we have civil liabilities as well. Like, is this willingly something that you're not being in compliance with? So there's the personal side of things where you could be held liable as well, and even in some jurisdictions, potentially jail time. So it just starts to these like ripple effects. I personally would not want to be the first one to be named for non-compliance for something like this.
Okay. And the second fold of my question was about the discrepancy between jurisdictions in terms of specific requirements for handling missing information and reporting. Is it something helpful to have a EU, harmonized rule?
Yeah.
Or does it make your job more complicated?
Yeah. So in the EU, there is explicit language in the TFR and the EBA guidelines on how to handle missing information, as well as reporting on non-compliance. And if you think about it like a triangle almost, right, where the two bases is missing information, reporting of non-compliance, and all of these kind of align into responding and increasing the response rate. And that it's not just enough to just send the transaction, you have to respond. And in TFR, there, like I said, there's specific language around that where I think it was paragraph 28, going off my memory, hopefully I'm correct, where there was reference that the originator and the beneficiary cannot be providing missing or incomplete information. And then further down, there was references that you should be responding promptly to requests for information. So in the EU, particularly, right, they have very specific prescriptive language that it should not exceed 3 working days for you to provide the missing information for any transfers that are taking place within the union. And then you have 5 working days for transfers that are received from outside the union. And then you can look at other jurisdictions, not as prescriptive, such as in the UK and Canada, where it's more so a reasonable time frame, they say. So you just have a reasonable time frame to provide this information and also reporting of non-compliance. And then you can look at Singapore, for example, that has this listed as you have 3 business days to provide the missing information. So it's very specific. We at Nota Bene have definitely provided multiple ways to help our customers contact and also collect this missing travel rule data from their counterparties, as well as to make it easy to report non-compliance.
Thank you. I think it's very clear. So you just said it's critical to respond to the travel rule messages, but perhaps you can give us some more background as to perhaps the evolution of those roles now, what you see coming. Of course, we don't have a crystal ball, but you do attend the meetings of the FATF very regularly, so you do have a pulse on what's happening in that forum, and the rules are coming out of there, it seems, and driven by FATF in particular. Can you give us a flavor of what is in making for the future, perhaps?
Yeah, and you're correct in that we're a member of the FATF Virtual Asset Contact Group, and yes, I do attend those meetings and represent the company. But you're spot on. It's super important to not only send and receive the travel rule message, but respond to them as well. And why is this so important, right? Well, simply put, in our travel rule timeline, what are we, 5 years since first adoption, supervisory authorities are starting to evaluate the effectiveness of travel rule, right? And this includes responding to these travel rule messages. And depending on the jurisdiction, it is no longer okay to just send a transfer and state to a regulator that I, as a CASP, am travel rule compliance because I just sent the transaction. You also have to demonstrate that you have been responding to these incoming messages from counterparties. And many jurisdictions have regulations explicitly mandating that VASPs engage in this two-way dialogue for travel rule compliance. And again, this means that merely sending the required information is not enough. I know I sound like a broken record, but I really can't stress this enough, that you must also respond to the missing or incomplete data, and you have to follow up information when it is requested by counterparties or authorities. And failure can really put your business at risk for non-compliance. And also, TFR goes beyond requiring accurate originator and beneficiary information and mandates that CASPs request this missing details and again are actively responding to these counterparty requests to rectify any of these discrepancies. And article, I think it was 16.1 or in Article 17 of the TFR, where they outline the responsibilities of CASPs to ensure that all transfers include accurate and complete originator and beneficiary information. And they also specify that CASPs must request the missing information from the sending VASPs and actively engage when this information is not complete. So responding to these situations essentially is crucial for compliance. And it's also worth mentioning that CASPs are increasingly choosing to limit their transactions to compliant counterparties. And this trend is evident in Nota Bene's own research, where 66% of surveyed VASPs reported restricting withdrawals with entities that do not comply with travel rule. So failing to respond to the travel rule message sends a strong signal to your counterparty that your business may not be fully committed to compliance, leading them to potentially cut off transactions altogether. And just to bring it back to FATF, of course, I cannot speak on behalf of FATFs, but I really do want to stress that they are looking to see from jurisdictions compliance and regulations with the travel rule, including effectiveness of travel rule, as I spoke about earlier.
Thank you very much for your time and for sharing your thoughts and your views. It was lovely to see you this morning, and thank you for managing to connect despite the hurricane about to hit you. Be safe. I would like to call my good colleagues back here to thank them very much for their participation, giving their time. I can see our Executive Director, Ricardo, appearing as well, and I'm going to give you the floor in a second. Wailum, thank you so much again. I don't know if Ronald is still connected, but thank you again, Ronald Coggins from MME in Switzerland, for joining us. Paolo, Greg, and Miguel, if you're still on the call, thank you as well for joining me today. We spent about an hour and 40 minutes. Unfortunately, you were all expecting Irina from Crystal Intelligence, who's stuck in an airport precisely because of the storm and the hurricane, and therefore delayed for her travel. But she's speaking tomorrow, and Ricardo is going to tell us more. Thank you for having me as your moderator today. Ricardo, the floor is yours.
Thank you so much, Izzat Begum. Wonderful panel, 1 hour and 40 minutes of great insights. Thank you so much to all the speakers for providing this wonderful discussion. Thank you also. INATBA Digital Blockchain Week will continue for the last session of this day. That is about AI and blockchain convergence, a very hype topic and hot topic, I would say, that will start in about roughly 1 hour and 20 minutes. Thank you so much. Stay tuned. Of course, the part of this session that was that, as Izzat Begum mentioned, was Irina couldn't make it, will be covered tomorrow after the two morning sessions after the quantum readiness. So that part on illicit activities, the report from Crystal Blockchain will be handled tomorrow. So keep on being tuned to INATBA Digital Blockchain Week. It's a pleasure to have you. It's a pleasure to have your questions as well. A very interactive chat. And see you in about 1 hour and 20 minutes. Thank you.
Thank you,
you.
everyone.
Bye.
Thank you. Bye. Hello, good afternoon, everyone, or good morning for some of us, or good evening. Thank you so much for being here for the last session of the second day of the INATBA Digital Blockchain Week. This time we are here with our some of the members of the AI and Blockchain Convergence's task force. That is a fairly new task force we have at INATBA since the beginning of the year, because we are very aware of the need to explore the convergences of blockchain and distributed ledger technologies with other technologies. I just want to state a few house rules at the beginning of this session. Please stay muted if you if you can. If you have any questions throughout the session that you want to ask specific speakers, please do so through the chat function. Most probably, because the agenda is packed, we might have time only for a few questions to address potentially only at the end of the session, but we will do our best, and our speakers will do our best to answer those questions during the 1 hour we have here together. Please also know the session is recorded, so I think you've already received a pop-up window about that on your screens. And without any further ado, I would actually like to give the floor now to a member of our Academic Advisory Board, Professor Ravi Sarati from the Northeastern University in the USA, who will lead you through the session today and who will moderate the discussion. Ravi, the floor is yours. Thank you for being here.
Thank you, Bara, and good morning from Boston to everyone. I'm delighted to be part of this panel, which is on trust and innovation, real-world applications of AI and blockchain convergence. And I'm Ravi Sarati, professor of international business and strategy at Northeastern University in the DeMoore McCabe School of Business. And our guests, we have a wonderful panel of guests here. Dino Dell'Accio from the UN Joint Staff Pension Fund, who will be discussing the UN's efforts to integrate multiple technologies such as blockchain, AI, biometrics, and GPS for addressing issues central to making US pension payments around the world in almost 100 countries. We have Matt Yarger, who is from DEMIA, which focuses on provisioning high-quality, secure environmental data in order to build trust in carbon markets using what DEMIA calls a decentralized Oracle network. We have Javed Khatak from Checked, which specializes in decentralized identity, DID, and verifiable credentials. And his company, Check, deploys a blockchain network that enables payments for credentials. And last, Dominic Tillman from Trust Level, which has launched a reputation-based evaluation protocol to measure the integrity and reliability of people on the network, of the information, of the data, and for the users. So what I'm going to ask my panelists is to take a few minutes each to quickly tell the audience, what they do, their main thrust from their businesses, and then we'll go around and I'll ask some more questions. Dino, would you like to start?
Sure. Thank you very much, Ravi, and pleased to be here. Thank you very much. So my name is Dino Dell'Accio. I'm the Chief Information Officer of the United Nations Joint Staff Pension Fund. I'm based here at the headquarters in New York. I've been with the United Nations for almost 25 years, and most of my career was in IT auditing and cybersecurity. I was the Chief IT Auditor of the United Nations for 10 years. I spent 3 years in cybersecurity, and since 2017, I've been appointed CIO of the UN Pension Fund. And in this capacity, I was presented with a challenge to design and implement a system that will resolve an historical problem that the UN Pension Fund had from its inception, which was the identification of its beneficiaries and confirmation of proof of life. Basically, the UN Pension Fund has a unique challenge, which is based on the fact that it has 86,000 individuals that reside in more than 192 countries around the world, and they receive periodic payments. And one of the consistent issues that the pension fund always faced was a questioning, particularly from the governing bodies, as well as oversight bodies, as to whether and how the UN Pension Fund could demonstrate that there was no fraud in the process of confirming the proof of life, because for almost 75 years, this proof of life verification was conducted through the mailing of a paper-based form that was sent through 192 postal services to 86,000 individuals, asking them to sign it and return it back. So in order to address this issue, given that proving a negative is impossible, I try to design a system that instead proves a positive using biometrics, specifically facial recognition, blockchain to create an immutable ledger of the events. Recently, we added AI in order to address the threat of deepfakes and global positioning system. Given my background in auditing, one of my trust area is about assurance of the use of these technologies, and I'll be happy to discuss this detail later on. Thank you very much.
Thank you. Matt, would you like to talk a little bit about DEMIA and carbon markets?
Sure. So a little background on myself. I started out doing cybersecurity and cyber operations and digital forensics at the NSA here in the United States. So I did that while I was active duty Army for about 8 years, and then the digital forensics part for the Department of Defense Cybercrime Center, where I got really nitty gritty on just how do we secure data, how do we ensure transparency and trust in things, did a lot of internal research on that. Then I pivoted to public sector, working for a German nonprofit known as the IOTA Foundation, where I led sustainability and smart mobility, working with companies like Dell and Intel, Jaguar Land Rover, Google, a number of European Union and Commission projects as well, and started working with the United Nations in various forms under different directories. I took all the IP that I had built in that capacity, working with partners at Climate Check, Gold Standard, and others across the carbon market, and brought that into DEMIA. So DEMIA is a for-profit based out of the United States. We were incorporated last year, and we have what you had mentioned, a decentralized Oracle network that has digital signatures built in, digital identities built in, verifiable credentials built in. Everything is signed, everything is encrypted. There's a very high level of security and assurance into what actually happens and how we can verify data and impact from the edge, from IoT devices or from various data sources. And then we bring that into a very clean user instance so that you can navigate that data. We're bringing AI into that so that we can parse that data, because we're pulling 10,000 data points a day minimum from these facilities. So it's a ton of data, especially if you're doing like a quarterly audit or an annual audit to look through. So how can we integrate like generative, or what we like to call regenerative AI, to actually make that impactful and make it easier to navigate, and then have trust in that data from the get-go. So it's really on our side, how do we create trust in data? And then how do we use that to create trusted AI? How do we speed up the entire carbon market? Because there is zero possibility that we'll be able to increase the capacity of auditors and assurance providers in the market to reach the goals that we all have globally for 2030, 40, and 50.
Excellent, thank you. Javed, would you like to talk a little bit about the checked business and DID and so forth?
Of course. Thank you very much, Ravi. So my name is Javed Khatak. I am one of the co-founders and the CFO of Checked. A couple of lines about my background. So originally, I am from a FTSE 100, kind of corporate background. Qualified as an actuary, so I'm a fellow of the Institute of Actuaries here in the UK. And for the last, I think, 6 to 8 years, initially worked as an actuarial consultant and then management consultant for FTSE 100 organizations, helping manage assets and liabilities of funds, £6 billion and over per client, and so on and so forth. And over the last 6 to 8 years, I've been operating in the startup/tech space. And like I said, I helped co-found Checked about 3.5, 4 years ago now. Checked is focused on essentially decentralized identity and verifiable credentials. And we launched our own network, which is also called the Checked Blockchain Network, with our own token, the Check token, which essentially facilitates the governance of the network, but at the same time allowing different commercial models to be built upon a network that uses check token as the payment mechanism for valued data to go across, but through a decentralized identity format or verifiable credentials format, where essentially you've got everything encrypted and you essentially use decentralized identifiers to verify whether a particular VC or verifiable credential is authentic or not. And the way we've approached the subject of decentralized identity, we love that how self-sovereign identity could essentially re-empower individuals with their own data. It can be privacy preserving, and all the credentials, all the personal data does not go on chain. So that sits in an individual's wallet, and essentially decentralized identifiers are used to issue credentials, or once they're issued, then verify credentials using the network. And I think finally, to close it off, is Checked is focused on providing the infrastructure to provide all our partners and users of essentially credentials or verifiable credentials to be building different use cases on top of our network, stuff like reusable KYC, stuff like within gaming arena, stuff like how we could use credentials within the AI space to answer some of the challenges that are faced by essentially the AI coming about and becoming part of our lives. So a lot of different use cases. Happy to delve more into detail a bit later. Thank you very much. Sorry, Ravi, you're on mute.
Okay. Thank you, Javed. Let's move to Dominic. And maybe, Dominic, you can tell us a little bit, introduce trust level to us.
Yeah, of course. Thanks, Ravi. And I apologize in advance if my internet connection is not stable. I'm on an island and internet is not as good as I was expecting it. So sorry if my connection is bad. My name is Dominic. I've been working in the blockchain space for several years. And during this time, I focused on data integrity and reputation systems, which led to the creation of Trust Level last year. So Trust Level is a decentralized reputation system that basically provides a trust layer to decentralized applications and ecosystems. To put it simply, when you're faced with a flood of information and it's hard for you to know what to trust and what's relevant, then Trust Level helps by providing reputation scores. And to make it more clear, I can give you like one or two concrete examples. So for example, if you talk about real world asset tokenization, for example, if you want to tokenize an asset like a real estate, it's crucial that investors can trust the asset issuer. And Trust Level here tracks the reputation of an asset issuer based on their past performance, legal compliance, and asset management, for example. So investors can verify the trustworthiness of an asset issuer and an asset before committing their capital. And if you talk about the medical industry, for example, trust there is, of course, very essential as well. So researchers, for example, need to prove their validity of their contributions, and patients need to trust the effectiveness of treatment protocols. So Trust Level allows here researchers to build reputation scores based on their studies, on successful clinical trials, and of course, real-world outcomes, which then can be used by doctors and to create more reliable treatments. And what is special about Trust Level and our system is that we have created a method for reviewing and evaluating off-chain data, which is usually highly subjective. especially when it comes to opinions, that can't be verified like so objectively. And why is this critical? Because as I've said, not everything is objective or like tracked on chain, but it impacts a reputation. So, for example, a value of an asset, it might depend on some external market conditions and expert evaluations. So you need to find a way to put that on chain, for example, or the effectiveness of a medical treatment, as I mentioned earlier, or a supplement, for example. So it often involves like personal feedback, clinical trials, and you need to connect them somehow to real world outcomes or results. Or if you go to like in a blockchain ecosystems, we have a lot of like grant programs, and the potential of a project or a team might, based on expert reviews, user sentiment, subjective feedback, what the team's vision and capacities. So we found a way to combining crowdsourced peer reviews, trusted oracles, and of course AI powered analysis to assess like this subjective information fairly, and so that both objective data and subjective information can be accurately reflected in reputation scores. Maybe 2 sentences about like our technical approach. I want to keep it simple, but we of course use decentralized identifiers, and also we combine it with zero knowledge proofs to ensure that the reputation can be disclosed without like showing like all personal data, which I think is super important. And of course we use different AI tools, but I think that's something we can talk about in the panel later. That's a brief summary.
Ravi, sorry, you're mute again.
Okay, it's fascinating to hear how many different ways the central problems that AI is creating needs to be addressed in terms of the quality of data, the dependability of data, the verifiability of the sources from which the data comes. And of course, these are problems that have been around for a while. So there are clearly many solutions, legacy solutions, existing solutions. And so one of the things that always arises when you try to come up with a new company or startup, a new approach is, how are we better? Why would customers adopt our solution as opposed to other solutions? So there's a question of buy-in from the broad the market. So perhaps I can go around the room, and again, starting with Dino, ask this question of buy-in. Who are the people who you have to convince, the opinion leaders or key internal movers and shakers, that allows you to then establish the growth and widespread adoption? I'm sure that's the goal for all of us. So why don't I go around and ask if you can answer that question, and of course bring in from your own experience and specifics of your company, what peculiarities might be there in terms of differentiation and convincing users of the superiority of your solution. And then a related area would be interoperability. Clearly your solution would work with other solutions so as to form a complete package for the user. And so in what ways are you thinking about that issue of integration and interoperability? So Dino, would you like to start?
Sure. Thank you very much for the actually excellent question, Ravi. Indeed, as I alluded to before, first and foremost in my case, the buy-in was needed from our governing body. And in my case, my governing body is composed of representatives of 193 countries. So it was quite challenging at the very beginning to explain the value proposition of the solution, obtain their approval endorsement for the funding to conduct first the test that we conducted between 2019 to 2020. And then finally, after we went back to them with the results of the test that we conducted worldwide, but specifically in third world countries in order to demonstrate the viability of the solution, obtain the go-ahead for deployment. So we went into production in January 2021 after we obtained the buy-in of the governing body, first and foremost. After that, of course, the second group of individuals, stakeholders that we had to convince was our beneficiary retirees that, as you can appreciate, also given the demographics, were not very at ease with digital technologies, concepts such as SSI, self-sovereign identity, such as verifiable credential, such as a zero knowledge proof, such as biometrics profile. So it was quite challenging to explain, again, the benefit of adopting a solution based on this digital technology. However, what worked for us was that indeed our beneficiary faced a real problem. And the problem was that in the manual paper-based process that the UN Pension Fund had adopted for 70 years, 75 years, there was always a big issue, which was represented by the level of uncertainty that our beneficiary had after signing the form and returning it as to whether or not the UN Pension Fund actually received that form. Aside from, of course, issue related to privacy, to security, potential forging a signature, and so forth and so on. But the real problem that our beneficiary experienced was that if and when the UN Pension Fund did not receive that famous signed piece of paper, by the end of the fiscal year, we, as a pension fund, we had a mandate to suspend the payment. And therefore, our beneficiaries were always in that level of uncertainty as to whether that form was received. Hence, continuous call to our call center to verify, confirm whether or not that form was received, or whether or not the next month they were actually going to receive their payment. So, if you will, this created the incentive to go beyond the initial concern, fears, unknown, skepticism of adopting digital technology. So that helped us to convince them in adopting the solution. However, there were also a lot of lessons learned. Unfortunately, we realized that the term blockchain was somehow interpreted as synonym of Bitcoin. And we were initially accused that as a UN entity, we were actually going to adopt a technology that was renowned for depleting the natural resources of the planet, because automatically there was an assumption that we were using proof of work, consensus mechanism, and we were going to create this huge overload and consumption of natural resources. So we had to conduct a campaign of explaining plain English by creating question and answer on our website, by conducting webinars to start socializing and familiarizing our end user with this concept, trying to reassure them that indeed that was not the case. Ultimately, again, going back to the governing body, and inevitably my core professional history is about auditing. One of my biggest problems is and was that by adopting emerging technologies, I immediately realized that we are also facing emerging standards for assurance. So I'm an ISO auditor. I'm a former ISO auditor. And throughout my careers, I always made extensive use of ISO standards in order to create my audit programs, in order to conduct my audits in the domain of IT, cybersecurity, network management, infrastructure, business continuity, and so forth and so on. So I immediately adopted the same practice that I used to adopt when I was an auditor, and I contacted back in 2020 my colleagues, the people I knew in the ICE organization in Geneva, asking whether there was indeed already a standard or some sort of a best practices to audit blockchain-based solution. And I remember them telling me at that time that, like, Dino, unfortunately, we are just about to issue the vocabulary of blockchain. So I was aware that there was a technical committee, a TC307, working on blockchain. I was expecting that maybe there was something more mature, but unfortunately, that was not the case. So that's when I realized also how challenging it was to go back to the governing bodies representing those famous 193 countries and trying to provide credibility, trying to demonstrate trustworthiness in this application. And it was very challenging. And I conclude, what I did, I reused what was available and I certified the application with the ISO 27001, which is not a standard for blockchain specifically, but at least it's a standard information security management system. And in that way, I was able to demonstrate that indeed due diligence was at least implemented and adopted in creating the management system. So all the processes, all the roles, all the responsibility, procedure, and so forth for the adoption and the integration of the blockchain technology in our processes. Thank you. Back to you.
Thanks, Dino. That was very useful. Matt, let's talk a little bit about DEMIA's positioning within the carbon market, verification space. Where do you see, the competitive advantages and the ability to sway users to work with you as well as with complementary solutions?
Yeah, so the big differentiator from what we're doing at DEMIA is we're really taking that like first principles system level view of the market. You see a lot of like platforms that are building black box solutions. You see like rating agencies that don't have a lot of transparency in how they're rating things. And there's just a lot of like gray space in the market right now. And so we took a really different approach from what we saw with a lot of other blockchain solutions, where we actually went to the standards first before building anything. We went to the compliance organizations, like we worked with ECCC, Environment and Climate Change Canada, in our initial pilots. We talked to UNFCCC and others to say, what does right look like in the first place? What's the right use of blockchain and the right use of like the capabilities that we have for blockchain? And then what's the wrong use? Like, what does the market not want to see happen right now? And how do we bring this together and like have a unified picture and approach to solving a real problem? And so we published a white paper with Gold Standard that got the attention of Google, who gave us $1 million grant to work with Gold Standard and bring 70 other organizations across carbon markets together. We did working groups under Gold Standard called the Open Collaboration to transform some guidelines on how we can step the entire market together holistically. And we said, this is what digital does. This is how we can increase and accelerate the monitoring. This is what the system level digital infrastructure looks like. Like, what are the boundaries around a project and an auditor and a certifier and a marketplace and a purchaser as the 5 key roles across the market? And then how do we actually use blockchain to interconnect all of these different boundaries so that we can enable transparency and trust in each of their roles? We can accelerate their activities, and we can use something that's secure and immutable and tamper-proof from the blockchain side to actually do that. So with DEMIA, we're really focused on the infrastructure side. We leverage a lot of my background in cybersecurity and my network there. And we have just all these different tools that blockchain offers brought together in one unified package in a way that's open core, open standard. And we're really trying to iterate on creating a digital standard for the market, which already has thousands of standards, but none of them are digital. So how do we enable those thousands of standards to come together in a digital infrastructure, be used in real time, and just enable everyone to do their job easier so that we can actually scale to address the problem?
Sounds like this really important step was to try to get all those 70 different organizations together. That must have been quite the feat. But
yeah,
I think
it's really difficult and understated getting that many companies to come in and say, okay, let's agree on something in the first place and say, like, this is where we need to be. This is what like the ideal outcome looks like. And then let's work backwards and figure out how we get there.
All right. Okay, Javed, let's move on to you. And obviously, SSI has been around for a while. I remember back in, I think, 2019, IBM had been working on SSID. And you talk in your injectee about building trusted data ecosystems. Is that something that could be a point of differentiator for you? What other ways are you thinking? Or the payment idea, using payments for credentials. So are those some of the ways in which you think you're providing a differentiated solution that might increase user adoption?
Absolutely, Ravi. I think that's a very good maybe starting point for talking about Checked. So at Checked, I think there's a few key things that we wanted to focus on at the outset to make sure that we are focusing on the end solution, the end user, the wider adoption piece, and figuring out what potentially might be some of the problems that the industry is facing. And if we could solve those, then it would automatically help the SSI, kind of world through that, the problems that, kind of the wider world faces. And as a result, allow us the positioning to be differentiated from, kind of existing competitors within the market. So I think talking about some of those, payments is definitely one of those key differentiators because we believe, I think we were the first one that are thinking about the entire SSI piece with commercial models coming into play because our view is that if you can enable businesses to be benefiting from a technology that is privacy preserving with zero knowledge proofs, giving, kind of data back to the individual users and so on and so forth, while they're still making profit, it would be a much easier proposition to sell to those, kind of corporates, enterprises, or ecosystems. And I think the other differentiator for us was while there were a lot of different platforms where you could come and issue credentials and so on and so forth, our focus was more providing the infrastructure to essentially allow different use cases to be built on top of it with the commercialization enablement through our, kind of token and so on and so forth, which I think has played out really well. And the way we approached it was look at the market and the existing SSI players that are looking at all the different use cases. And we essentially entered into partnership with more than 60% of the market as partners of the Check network, building their own thing, kind of serving their own enterprise customers or ecosystems, and allowing or building either on top of, kind of Check network or allowing their solution to be able to be, deployed on Checked. I think we've also focused on another differentiating, I think, point would be interoperability. And the way we're doing that, I think, is, again, there's several ways. One, we're allowing the different projects or users, even Web2 and kind of potential clients, to use or benefit from SSI solution without having to necessarily directly use our token. Because a lot of people, a lot of companies, kind of might be concerned or pushed, kind of by their compliance departments around getting involved in crypto and tokens and so on and so forth. So potentially they could use, kind of stable coins or even fiat to essentially deploy or use, kind of SSI solutions. So I think those are some of the ways where we've made sure that while the existing SSI ecosystem, existing SSI thinking provides a lot of benefits around zero knowledge proofs, privacy preserving, and all of the stuff that we've touched upon earlier. But we believe that some of these other things that we're missing, and if we're providing that to, kind of the world, that would help solve some of the problems or blockers and differentiate Checked, kind of from other players within the market, and I think there aren't many players that are operating at the infrastructure level in the first place. And I think finally, to close that off, is we've just announced, I think recently, a few weeks ago, to be one of our partners / potential competitors, Doc. They're actually sunsetting their blockchain network. They provide, again, SSI solutions to their kind of clients. They do a fantastic job of the front end and the actual solution and so on and so forth. But they want to focus on the solution side of things, and their focus and adoption and improving that solution rather than having to worry about the infrastructure layer. And they, I believe, noticed that Checked is an innovator with our kind of trust registries and did linked resources that we essentially kind of innovated. And what we're doing with the entire SSI ecosystem, our thinking, our blockchain, how we operate, how we update it, and so on and so forth, they've decided to move to us, sunsetting their blockchain network and token as well, which I would hope is a testament to already, kind of proving that we are differentiated in the market. Passing back to you.
Thank you, Javed. That's interesting because I think that's likely to happen more as different pieces of the ecosystem realize that they actually are very complementary. And I'm reminded of ASI, the merger between Fetch and the couple of other, I think Ocean Protocol, where they sort of said we have roughly the same customer base and we're approaching it from different directions. Why don't we combine forces, and that way we get scalability? So I suspect that's not unusual. It's kind of likely to happen more and more. Let's move to Dominic and trust level. Dominic, what I'm struck by is how broad your remit is. You're trying to address data reliability, which is not just one vertical segment or one vertical user segment. It's really a very broad need all across blockchain and AI usage. So my question to you is, how hard or difficult is it to approach such a broad market? And are you trying to prioritize within that remit and saying, I know I have many, many possible customers in many different areas, but let's go for the low-hanging fruit first? So are there, one or two areas that you're really prioritizing in terms of building up user adoption in your company?
Yeah, excellent question. And that's exactly, I would say it took us almost a year to kind of decide on what to prioritize at the beginning, because there are countless industries actually in use cases where you could apply that. And for us, the challenge was a little bit to see, okay, what is an easy start, and also what is easy to monetize at the beginning, because at the end it's someone needs to pay the whole thing. So our start was in evaluating proposals in grant programs, because that's where we came from. So we got our first grant was to create a kind of a proposal evaluation system for a grant program, and from that we kind of started to expand a little bit, and our two main industries or main focus is like medical industry, the medical research industry, because I think there's a lot of money involved, and it's like a very critical industry. I think everyone can tell a story on how they were not happy with their treatment or stuff like that, and there's so many like contradictory information or conflicting information out there, and especially like it's hard to, if you Google something or ask AI something about a specific thing, it's almost impossible for a single person to evaluate if the information is correct or not. So we try to tackle that field, and the second thing is real world asset tokenization, which is a bit of a buzzword at the moment and a lot of hype, I would say, but of course also a lot of potential. And so that's kind of the two things that we focus at the moment. We have we are still early, so we have limited resources, and so we need to kind of make decisions on what to focus first. And yeah, the funny thing at the beginning is when I started with this like vision for trust level, I wanted to kind of start to create a protocol at the beginning that is able to accommodate like all the use cases, and of course that's a hard way to start. So we need to simplify the whole protocol or the whole approach, and we're also like really looking, okay, what's the biggest need, or really the value that we can create. And it turned out that, like, especially what I mentioned in the beginning, like the subjective information, how can we make that usable? How can we make expert opinions like usable in a structured way? And the grant programs actually were an amazing like playground, because we had a lot of like data, a lot of active people, and kind of an easy metric to measure like the outcomes of projects, or the reviews of projects. So it was kind of easy for us to, because that's the thing with reputation, like what's the metric actually, and how to make it measurable. And it turned out that it was kind of an easy use case for us to see how it could work also for other industries. And now we try to move to different industries and try to see how we can apply it there. Back to you.
What you were just saying is very interesting in terms of multimodal data. You know, a lot of subjective information out there. And so much of AI is around using multimodal data, very unstructured, and then trying to make sense of it so that the AI LLM or algorithm can actually start detecting patterns, making inferences. And since this panel is about the convergence of AI and blockchain to some extent, I'd like to maybe go around the room and ask each of you, to what extent are you using AI? What kinds of difficulties have you had in trying to move in that direction? And where do you see yourself going in being able to successfully integrate AI with blockchain and solve some of the problems? Blockchain, for example, smart contracts is a very big issue. Smart contracts can be faked, and AI can be used to try to, prevent that kind of intervention with smart contracts. And the same with oracles. Smart contracts get triggered by oracles. AI can help detect deep fakes in the oracle process, the decentralized oracle network, for example, that was being talked about. So that would be my question to you. So why don't I start with you, Dominic, and then go around the room about this issue of convergence of AI, blockchain, and its specific instantiation in your operation?
It's but first I have to say AI changes everything, and especially like the evolution of like the latest models, the release of the latest models. They change everything, and at the same time, this is for me kind of the biggest challenge at the moment, because the space evolves so fast that it's almost impossible to keep up with like every new thing that is released, or every new paper that's published. So to give you one example, we have in beta like an AI-based bias detector for news article. So that was also based related to a grant that we got. And we were a few times just before releasing it, and then a new model was released, and we figured, it makes actually more sense to move to the new model because it's already so much better. And because biases is such a nuanced thing that every new model brought like the small improvements that make a big difference. So we kind of had to start all over again, and not all over, but I think that's, for all of us, I guess, a big challenge also in zero knowledge proofs. It's just crazy what happens. And for those who know us, we are like very active in Cardano, or that's where we come from. And they just released a new sidechain for zero knowledge proofs, and that changes everything for us because it makes it so much easier to apply that. a lot of work we did in the past few months is not really necessary or not really relevant anymore. So yeah, I guess that's a very big challenge in the industry, but at the same time makes it also fun because yeah, especially for like new teams, if you find like a sweet spot in one of these technologies, and yeah, you can quickly gain a lot of like traction and interest in your product. But at the same time, if you yeah, your new tool can be old very quickly. So yeah, that's I guess the challenge that we are facing. And yeah, in terms of yeah, AI, like how we use it, of course, like without AI, I would even say it's impossible to create a reputation system because reputation needs to be like dynamic. And without AI, it would be just like a dump system that is not really useful. So yeah, we use it to analyze user behavior, of course, to prevent fraud, but even to evaluate subjective opinions, it's like very useful. So of course we have like experts, what we call like crowdsourced peer reviews. So like still real people are being involved, but using LLMs to evaluate like the reliability or trustworthiness of information becomes more and more useful. To be honest, of course, these models have their own bias, which is tricky. And the funny thing is what I mentioned with the bias detector for news article. When we trained the model, we used one data set was about the US election. So we had a lot of data that involved Trump and Biden and stuff. And we figured it's not working. Like the results were always kind of misleading because I guess the models are somehow biased in that field. So
Yeah.
we've
Great. Thanks.
Yeah.
So let's hear the same issue from some of the others. Perhaps Matt, you'd like to take a stab at that? How the carbon credit market and the fraud in terms of the edge devices that you mentioned and so forth, how AI might help in both detecting fraud and making the carbon credit market more dependable, so that both nation states and companies will feel more comfortable dealing with the carbon credit market.
Yeah, with the carbon credit market, there's a lot of considerations for AI right now. One is how do we make it sustainable, first off? So there's a big concern just on the increase in energy consumption from AI. But I don't think over the long term that's really much of a concern. You kind of see this natural process where we have a big centralization of resources, and then it starts to distribute out in a more efficient manner. And I really think that's what we're going to see happen in AI over the next 5 years. But with carbon credits, it's just how do we automate the parts that are necessary, but how do we also bring trust into the AI model and ensure that we are verifiably understanding the impact that's happening on the ground? So with our data Oracle network, or decentralized Oracle network, a lot of it's enabling the right tools and functions in the baseline, whether it's digital signatures, whether it's encryption, whether it's key sharing or those kind of things, so that the data is verifiable first, and then it's using AI to automate that verifiability so that we can actually do it in real time. So we're using such a high amount of comprehensive data in our data models that it's not building an AI model based on like estimations or sampling anymore. It's got full access and a very contained system for actually reading data in a dynamic way and producing a verifiable output in a dynamic way. And the ability for AI to do that at scale completely transcends what we can do as like individuals or auditors or assurance providers. And it changes the role of the auditor and assurance provider to where they're not necessarily having to come in and do the really heavy, tedious work that they spend days and days or months sometimes kind of crunching through the numbers on. They're able to come in and look at the input and look at the output. They can trust the input and they can verify that the output's correct. And so then they're actually coming in to provide assurance on the model and the AI implementation from the data and saying, yeah, this system is executing as appropriate. So they might be able to do, weeks worth of work in hours and do 10 times as many projects from an auditor and an assurance provider perspective in a much smaller amount of time, also increasing their margins. So there's a much higher level of profitability because they can offer the same service for a lot less and have a higher level of profit because they're using the right tools to do it as efficiently and effectively as possible.
Yeah, I was reading just the other day about one of the major verification agencies having some troubles with their verification center. I think it was Vera, if I'm not mistaken. And that was partly, I think, something that could have been solved if AI had been involved at an earlier stage, because then you wouldn't have had the kind of bias that led to, the problems. Let's see, Javed, do you want to talk briefly about AI use within the space in terms of payments for credentials and verification of credentials and allowing third parties to build solutions on top of your basic infrastructure, your backend, so to speak?
Absolutely. Thanks, Ravi. So I think I maybe will try and answer the question slightly differently. So I think one element of the use of AI, because we're at the infrastructure layer, we'd expect more our partners essentially to be utilizing AI that is more relative or relevant for their use within their ecosystem and use. But how we're essentially looking at AI at Checked is some of the challenges that AI kind of poses to the world, Web3 world, Web2, and so on and so forth, and how we can potentially be part of the solution there. And I'll just talk briefly about a couple. Essentially, due to AI, the entire element of any type of content, whether it's kind of photo being taken by at the hardware level or a piece of photo later on being edited by a third party or whoever else, and what level of edits have been done, who is the actual owner, the provenance of kind of the original content, all of that has been really made complicated or convoluted and potentially difficult to understand, kind of with the advent of AI. So one potential solution to that would be something called content credentials, which at the moment there are a couple of kind of bodies, content provenance and authenticity, or C2PA initiative, which is started, I think, by Adobe, ARM, Intel, Microsoft, and so on and so forth. We are part of that initiative, as well as a content authenticity initiative, CAI. So essentially, they are setting the standards for everyone how to potentially use content credentials to make sure that that content credential tells the user of that content who's that from, has it been edited on the way, who might be kind of attributed in terms of adding value to it on the way to kind of you as a user, and so on and so forth. So we strongly believe that SSI could be a very strong solution for that. And obviously, if we're the payment provider, kind of, or rather payment-enabled solution for that, then we're hoping that that might actually stick with other organizations utilizing that, where commercial models are built on top of it, but solves, kind of some of the problems that are provided or posed by, kind of the advent of AI. Similarly, given we've got limited time, I'll just, kind of name a few. Data sets, we've talked a little bit about, kind of data sets where if you do not have if you've got synthetic data that is going into AI training, only 7% of synthetic data apparently could, again, I'm not a tech guy, but my CTO and co-founder Anko tells me 7% synthetic data could lead to model collapse for AI. So again, how do you verify the data is genuine, authentic, and so on and so forth? I think Dominic was touching on that as well. So again, SSI could come into play, VCs, verifiable credentials, with the issuers of data, converting some of that metadata and putting into VCs, and then the users of AI training their models, potentially utilizing that. And then there are other things that we're working with, kind of potential partners exploring some of the, again, problems like AI bots, kind of they could essentially be, again, utilize, kind of VCs would, kind of enable benefit and solve some of those problems. But given the time, I'll pass back to you.
Yeah, we have just a few minutes left, but Dino, would you like to talk about how AI might have helped you get more buy-in, as well as improve the quality of the solution, speed it up, maybe help scale it up, and also ultimately make it more efficient?
Yeah, thank you, Ravi. Very briefly, I don't want to go to overtime. Basically, our specific use case was to make sure that our biometric algorithm for facial recognition was able to withstand potential deepfakes attacks. So we decided to fight AI with AI. So we follow two processes. First and foremost, we submit on a regular basis our biometric algorithm to NIST for the face recognition vendor test, FRVT. And the second thing we did is that we developed and we implement the integrated an AI module within our application. However, again, my obsession of an auditor was, how do I demonstrate it works as intended? Matt alluded to using the blockchain. I recorded in a mutable manner the event, the input and the output. And in between, now I'm submitting our module to the ISO 30107-3, which is a specific ISO standard for testing both the capability of an algorithm based on AI to withstand presentation attacks and to withstand injection attack. So hopefully the result of this test will demonstrate that our algorithm and our AI module is indeed capable of withstanding presentation attack detection. Thank you.
If I hear you right, this is a project that's underway, or have you got results to be able to say this is working?
I'm engaged. No, so we already implemented, but I want to add that piece of certification. It's not really a certification; it's a testing methodology, and there are very few entities around the world. I think there are 4 or 5. I had some challenges in identifying potential vendors that are accredited to conduct this test, and I'm working with the procurement division to engage one of these entities to conduct the test on our AI module. Hopefully, by the end of the year, we have the result and go to my board and support with the evidence, corroborating evidence, the trustworthiness of our application.
Excellent, great. We run out of time. I could go on for another hour because there's so many interesting questions I could ask you, and I think our audience will be very enlightened. I want to say, first of all, thank you for taking the time to come to this panel and for telling us and the audience about the amazing and interesting efforts that are underway to try to address very fundamental problems surrounding the introduction of AI into the blockchain space. And also, I think solve real user issues. These are not just academic and theoretical ideas, but these are issues that I think that have real pain points among users. And so I think one of the first things about any good business model is if it solves pain points for enough users, you're going to have a successful business. So I'm going to wish all of you great success in continuing these efforts. And I hope I get another chance to catch up with you again and hear more about your progress and perhaps communicate to our audience at a future date. So thank you very much again. And thank you all of you for attending and listening to us. And thank you, Bara and INATBA, for organizing this panel.
Thank you so much. Also, on behalf of INATBA, to all the speakers, and Ravi, to you for moderating the session. We will be happy to continuing the discussion. Thank you also to the audience. I just want to invite the audience to the last day of the Digital Blockchain Week, which will take place tomorrow. We will have 4 sessions during the day. The first one will focus on liability compliance for Web3 developers and early stage DAOs. We will also touch upon the topic of quantum readiness in the blockchain ecosystem. We will also talk about blockchain for social impact and transparency. And we will conclude the Digital Blockchain Week with a fireside chat session with Scotland and understanding how the government is using blockchain technologies to advance their projects. So thank you so much. Have a nice rest of the day, and we'll hopefully see you tomorrow. Thank you.
Thank you.
Thank you. Bye-bye. Thanks, everyone.